70% of parents today. The euro at 107.42, up a tenth of a percent. We're heading towards, of course, as Tom, you point out, that important ECB decision. It's on a knife edge, a cliffhanger, choose your metaphor. The Bloomberg dollar index down a touch, down a tenth of a percent. That's giving some upside to equities through the Asia session as well. And the Brent crude price, we put that in because we spent a lot of time this morning talking about whether higher commodity prices are inflationary. To get to that part of the conversation, you first need to get through whether we're going to see higher commodity prices. Well, this morning we are, Tom, and sometimes that is positive for energy names. What do you see in the futures?
Bit of a holding pattern threatening here, seeping into these European futures. You're pointing lower by about a tenth on the DAX, flat on the FTSE 100, and over in France, the CAC is pointing lower by about 8 points, Anna.
Okay, so a little bit of downside then, perhaps, for European equity markets at the start of trade. Interesting that US futures are pointing higher at this point of the trading day. We will see how that fares as we get closer to the US Open. But at this stage, we are expecting something a little brighter when we get to the US trading day. But this is the FTSE 100 up by just a tenth of a percent. We are through that big risk event that was the CPI print. A lot in the market, a lot of people, of investors would have been very intensely focused on that CPI print. And the fact fact that the market shrugged, maybe that gives us another platform to bounce off here in terms of markets. But the FTSE actually going a little higher this morning, up by 0.2%, even if the rest of the markets are a little flatter. Perhaps that will have something to do with energy prices. This is what we see on the FX markets. I pointed out the slightly weaker dollar, a little bit of strength in the euro. We're heading into the ECB meeting with that setup. Worth bearing in mind that the dollar just on the back foot a little bit after its recent run of strength, and the euro still around that 107 handle as we approach that crucial cliffhanger at the ECB. We're seeing buying of sovereign bonds, so we're buying stocks, it seems, at least in the run-up to the US Open, and we're buying sovereign bonds, some of those yields coming down a little bit. And interesting to see that on the commodities side, we do have Brent crude and WTI bouncing to the top of that board on the GMM. So it does suggest that we are seeing some slightly outsized moves on commodities this morning. Whether that is inflationary, of course, in the longer term is a bit of a different question. Tom, what do you see on sectors?
So very modest gains across the benchmark, just as we reflect on the context, just a gain of about 0.1%. But you lift the hood and there is a little bit more interest in terms of these individual sectors. Basic resources, and we've seen these iron ore prices creep up, that demand coming through from China, and prices leading to a little bit of upside for the basic resources as a sector, gains of a little over 1%. Energy is also up 0.4%. We reflect on Javier Blas's insights into Arab Light and the fact that that is actually close to $100 a barrel and the need for policymakers to focus on that. Retail is now gaining 0.3%. It was the biggest loser across your sectors yesterday. It was banks, it was insurance that came through and remained in the green, even as overall across European equity markets you ended lower yesterday. Financial services today adding just 0.1%. Tech is also up by 3 cents, but the focus in terms of the biggest moves coming through for basic resources, currently up 1.1%. Autos also a factor, of course, for the DAX, a big factor, currently down 0.6%. Again, as we reflect on that really consequential move by the EU to launch an investigation into Chinese EVs. Anna.
Okay, let's dive deeper into the themes affecting markets then this morning. Eddie van der Veld joins us from the Bloomberg Markets Live team. And let's just reflect on the past 24 hours then, Eddie. We had that slightly hot print on core CPI, but the market shrugged. I mean, that tells us something, doesn't it, about what the market is and is not worried about. It seems despite that data, we're all supposed to be data dependent these days, despite that data, the market is not overly concerned about higher rates from the Fed at this point.
Yeah, you know what? I think it's from my perspective, I thought it was a little bit more nuanced. I thought that the Fed is that the market is certainly still worried about inflation. I think, in fact, that the market was positioned for an even hotter reading. The market was expecting inflation to come back with a bang, and that would therefore force the Fed's hand a little bit. And I think that, because what we saw was this hot print, and immediately there was a knee-jerk reaction, with a stronger dollar, and then it actually faded. And I think that, to me, was really telling in that the market is worried that we're going to get this second wave of inflation coming back, and that's going to force central bankers to backtrack. I think, on the other hand, policymakers are sitting and they're feeling quite good about what is happening at the moment. Sure, the economy is slowing a little bit, but it's not crashing. Inflation's ticked up a little bit, but it's not resurging yet. So I think the policymakers will probably look at this and say, hang on a second, maybe this is, in the Fed that is, say, hang on a second, this is maybe a time to kind of sit on our hands, not to be too aggressive and not to, not to tank the world economy. So I think they are saying, okay, we've done the higher bit, now we're at the there for longer bit, and we're going to keep it there. So I think there is a split in what the market thinks and what the Fed thinks, and that is where we're positioned, and that sets us up for volatility going forward.
Volatility going forward then, as the door seems to be open, remains open for the Fed to come through with another hike as they weigh that data. I think the context around the United Auto Workers dispute is also going to be really interesting, and that strike could start in some form later today, an impact, of course, on wages. When it comes to the capital markets then, and the centrality of ARM, Eddie, how are you thinking about the catalyst effect? Or are we overreading it? Is there really going to be this catalytic effect from ARM opening up the capital markets and all these companies coming to play and listing?
Look, I genuinely think that this is a watershed moment, right? I think this is going to tell us something about what is going to happen and where investors' sentiment on things like chip stocks, things like the tech sector, and more broadly on speculative investment is. Because this is exactly the sort of IPO that ties into the market narrative. It's about chips. It's about the AI play. And if investors cannot get excited about this, that tells us something about, that the rally, that the price levels that we're seeing in the broader NASDAQ for things like NVIDIA may be overdone. At the moment, that doesn't look like the case. It looks like there is strong demand for this IPO. If we do see a post IPO pop and we do see investors buying in, I think that bodes very well for particularly retail investor sentiment, right? And I think that sort of sentiment can carry a market and therefore can carry sentiment in the broader economy. So I do think that maybe it clearly doesn't shift the macro narrative, but I think it defines the macro narrative, right? It tells us something about where we are and therefore where we're going.
We've had some data out on the UK housing market as well, Eddie, this morning, which is perhaps worth spending a moment on and reflecting. Because, of course, housing is an area of the UK economy that many people are watching very closely to see when we get that pain with all that refinancing of mortgages that's set to take place. But RICS, the Royal Institution of Chartered Surveyors, saying that in their latest survey of estate agents, so those who sell houses, they are reporting some pretty weak data, the fewest sales since lockdown coming through.
Yeah, and we're hearing talk of a relative steep fall in house prices across the region, right? And house prices are extremely important in the UK in terms of setting the consumer mood and people's spending patterns. Now, the Fed is in one place, the ECB is in another place, the Bank of England is in a very different place. It's struggling with very real stagflation already. And how do you address that? Because hike rates further and you really tank the housing market, which tanks the economy. Don't hike, and you're struggling with this inflationary environment that's not going away. So the Bank of England has got a really sticky position, and I think the housing prices that we saw and the broader housing data that we're getting is both. It both defines and it sets the trend that we're on. So I think that is absolutely the one key thing that I'm watching in the UK.
Okay, yeah, the housing market potentially standing in the way then, the block to further tightness from the BOE, or at least as much tightening as many, of course, had previously expected. I'm looking at gilts, currently flat. Okay, a little bit move of 1 yield, 1 basis point, I should say, on the yields, on the 10-year at 4.33. But it's worth noting that the 2-year, to your point, is back below 5%, 4.97, as money has moved in to UK sovereign debt this week. Bloomberg M Live's Eddie van der Walt walking through some of the key market themes for us. Thank you. Let's take a look at some of the major events on the docket then today. 1:15 p.m. UK time. We are going to have that ECB rate decision. Maria's on the ground. It's going to be followed by that news conference by President Christine Lagarde. Bloomberg Economics forecasting that the central bank will actually push through a 25 basis point hike for the final time in this cycle, bringing the deposit rate to 4%.
Yes, and our guest earlier on also of the view that we'll get that hike today. We will get the view of Pooja Kumra from TD coming up shortly. At 1:30 p.m. UK time, we'll have US retail sales and PPI data. Is it important to think about how the markets responded to yesterday's data around CPI when thinking about that retail sales picture? And later this afternoon, it's the blockbuster IPO of the year. Chipmaker Arm has set the IPO price at $51 per share. Trading kicks off on the NASDAQ at 2:30 p.m. UK time. And of course, that is going to be closely watched. Eddie was giving us his view, and we got yesterday the view from the capital market side, didn't we, that this is going to be something that will set the tone. So we'll certainly keep an eye on that. But the retail sales data has to be something to watch as increasingly guests are talking to us about that depleted stock of savings in the US.
And Mark has been highlighting this, Mark Cardmore, of course, from the M Live team, around this being central for his view that you're going to get a recession coming through in the early quarter, the early part of next year, because that consumer's become weak. And we've seen some of the big retailers, some of the big names in terms of the household goods sales and things like that. In terms of retail sales, people are, it seems, downshifting, downgrading in the US to cheaper goods at least. And then there's the payment around student loans and student debt that many US analysts forecast as well could prove a further pressure point. And
you mentioned the strike activity around the auto sector also being watched as something that could weigh on the US economy. We need to talk about the ECB.
We do indeed. Yes, it is a razor edge rate decision. Will the ECB hike or hold as that sticky inflation worries, those sticky inflation worries continue to swirl? And what's going to happen in QT as well? Could that be a surprise up the sleeves of ECB officials? We're going to be live for you in Frankfurt. Maria Tadeo joins us next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today, 12 minutes into Thursday's trading session, waiting for the ECB, of course. And in the midst of that wait, we see European stocks actually in two minds about which direction to head in. Perhaps it's the energy story that divides them. We see the FTSE 100 up by 0.4% as Brent goes higher, still 92.51 actually on Brent, and that's pushing some of those energy names higher. The CAC 40 is flat to negative, so is the Xetra DAX. US futures, though, pointing a little higher.
Well, how much is that energy story going to play into that decision? I don't know if we've told you yet, but it is a knife-edge decision today from the ECB, the European Central Bank, on whether or not to raise interest rates for a 10th straight time, or indeed to pause. Or will it be a hawkish pause? Well, our cliffhanger correspondent, Maria Tadeo, is on the ground for us in Frankfurt. She's been charting all things ECB, of course, for many a year. Maria, is it going to be a hike or a hold? You have the answer for us. This is exciting. Drum roll, go.
Look, I wish I had the answer for that. And of course, you would love me very much if I knew that already. But actually, at this point, that deliberation is probably already being made, considering the time that we're in at this point. But this will be now about the fine-tuning and the release, but also probably she is prepping now this press conference. Now, in terms of the market positioning on that, I could offer you an answer. I do have an answer on that. There has been this change in sentiment, which has been very interesting to track almost on a weekly basis how the market position and the reposition again, and then now is placed for a hike. When you look at money markets, and of course I'm just referring to that, the most likely outcome of this meeting will be another rate hike. That is a 10th consecutive. We should see now the deposit rate to 4%. Of course, we should note, because the context really matters, a lot of this change in sentiment was precipitated, really driven by that report that Reuters put out, then Bloomberg also confirmed, which is connected to the economic forecast that the European Central Bank is also expected to provide today. Remember, this is seen as crucial when it comes to the narrative around the monetary policy decision. And if that report turns out to be correct, again, Bloomberg also appeared to confirm it yesterday, we could see inflation still above 3% next year. And the reason why I emphasize the timeline here is because 2024 was seen as the crucial year, the crucial test for the transmission. Remember, the idea of this meeting, that decision would hinge on the transmission. If you believe it is strong already, given the cumulative effect of the rate hikes that we've seen so far, that could merit a pause combined with the weak economic data. If you believe that transmission, maybe it's not there yet and it merits another rate hike, then that would lead to, as I say, this rate hike today. Of course, at this point, it is just now a matter of hours waiting for that release and then that press conference with the head of the ECB, which today will be, frankly, a difficult communications exercise. I feel like I say that every meeting, but today will be crucial to explain whatever happens. What is the rationale behind it?
Maria, thanks very much. Maria Tadeo in Frankfurt. Thanks for the update. And as Maria points out, we'll bring you the decision itself. We'll also bring you, that's at 1:15 UK time. We'll also bring you the press conference from President Christine Lagarde. That takes place shortly after we get the decision. We're joined now in studio by Pooja Kumra, Senior European and UK Rates Specialist at Toronto Dominion Bank. Pooja, very nice to speak to you this morning. So are you in the hold or the hike camp? And whichever one it is, do you expect a dovish or a hawkish sort of tilt to the action?
Do we have a coin here? So we are slightly more biased towards a hold, just given the fact that in July, data dependency and financial conditions were the key premise for the next rate hike, and both had not worked in favor for ECB, given whatever in terms of data we have seen. But I think right now the key picture is that markets are kind of priced for a hike, so it should not surprise them that much. And unlike the Fed, ECB does not have a dot plot. They cannot show that more hikes are coming. They cannot show that they're going to be restrictive in 2024. And I think that's where just talking restrictive may not really have a bearish impact on rates, because markets are following data, and data is clearly not working in favor of ECB. So I think whatever we see today will be a very short-lived reaction. We think we could rally when it comes to rates, especially given the fact that later in this day, we will also get US retail sales where we will see weakness, and that's the last key data that Fed has going into next week's meeting.
Okay, so it's a number of factors that feed into what happens with the yields from here. How are you thinking about positioning? There is a consensus, it seems, that we're getting very close, if we're not already there, to a pause scenario for these central banks. And we may be 1 or 2 hikes away from that. But is it too early to start to position around that as you look to 2024?
So, yes, I mean, clearly hawks don't have much say now. So, as you said, we are basically done with the hiking cycle. And what we have seen in terms of yield moves from August, there has been a bearish price reaction everywhere. We say, that this is, bonds are a good buy at 250, but they go to 260 or 265. But I think we are done with that kind of rhetoric. September is key meeting where we'll get the next forecast, and it's hard to see higher core inflation forecasts coming in. We are seeing slowdown in data. And I think that's where I feel yield buyers are going to come in. We were waiting for 1 or 2 weeks in September for all the big chunky supply to actually have its impact on rates. And I think that supply pressures will ease. And I think that's where so many buyers have been actually looking for a buying point for duration, have not entered the market. I think right now they could actually look at where good points to enter. But I just feel for euro, bonds are still relatively long on a cross-market basis. So I think the rally will be led by treasuries rather than bonds itself.
Can I pivot to the UK conversation, Pooja? Because it's easy to chart the negativity around the UK. We've seen GDP data this week come in weaker than expected. We still have wage pressures. One guest described the data set we got around wages as being classically stagflationary. And we know that the stock market has been beleaguered this year versus the competition. But is there any sense in which the UK economy is looking up? How do you look at the UK at this point?
I wish BOE had also what vision. So I think in general, going into next week's meeting, we are seeing at least data going in the right direction. And I think something that you referenced in the show earlier, housing market is a big concern. We have seen 7 to 8% drop in houses. But on the other side, we are also seeing a 7 to 8% rise in wages. So the entire picture for UK in terms of growth and inflation is very uneven. If you have 10 indicators showing that inflation is high, you have 10 indicators showing growth is crashing. And I think, but given what Bailey told us last week, I think we are in the stage where they are also ready to pause. I think next week's CPI is a big number, but we are looking for downward trend. And I think that's where BOE can actually say that, the lag impact of policy will be more in play. And they would also like to hold on the kind of mortgage repayments that will come across in Q4. I know there's a lot of talk about it, but going into October, we will see more movement around that.
Yeah, and we've seen a few issues around repayments of mortgages coming through from the UK, and that issue has started to step up. Would you lean into gilts? Where would gilts factor in your portfolio at this point?
I'm super long gilts versus bonds. So that, as I said, from a positioning perspective as well, I thought that markets were really short gilts. And that's why in the last couple of sessions, even when bonds have sold off, gilts have managed to rally. And even if you see the wage number, it was high, but still we rallied. So I think in terms of positioning, I think where you are getting yield, where you are getting cross-market even attractiveness, I think gilts are pretty much favored.
Okay, Pooja, really smart insights. Thank you very much indeed. Pooja Kumra, Senior European and UK Rates Specialist at Toronto Dominion Bank with that bullish call on gilts here in the UK. Coming up, we're going to look at the day's biggest equity movers, including Exor. It's the biggest gainer on the Stock 600 after a share buyback announcement. We'll bring you the details. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Could face bigger challenges.
Uncensored was going to keep rate World Cup. This is a 3.
As the economic picture down. The BOK is getting ready to make a decision.
This is Markets Today, 23 minutes into the European trading session, and European stocks just grinding out some very modest gains of 0.1%. US futures pointing up. We look ahead to that ECB decision later today, of course, 1:15 p.m. UK time. Anna.
Yeah, absolutely crucial on the macro agenda. We'll get a check on the markets, though, now, and the individual stocks on the move. Here's Lizzie Burton. Lizzie.
As Tom says, it is ECB day, so let's kick off with the European banks. They're as confused as the markets have been on what we're going to get in terms of the rate decision today. Look at Deutsche, BNP Paribas and Santander. Markets now pricing a 2/3 chance of another hike. Could we also see a hawkish QT surprise? Our economists at Bloomberg Economics say you can't rule it out. I've also thrown in UniCredit, however. That's actually down 1.6%, and this is because it's Italian, and we've had the news that Giorgia Meloni, the Italian Prime Minister, says the windfall tax on banks' profit could be tweaked as long as the state gets what it expects to receive in terms of income, around 3 billion euros. So those shares down this morning. If we flip the board, some other stocks on the move at the open, we have Exor. It's up 5.4% nearly this morning. This is after its first half results and the announcement of a 1 billion euro buyback. Also throwing in Pernod Ricard and Rémy Cointreau this morning, both down at the open after they've both been double downgraded by Barclays on some modelling that shows there's going to be a 22% drop in the 25 to 45 age category by 2035. This, of course, a key market for those spirits. When you've got a backdrop of slowing economic growth, you're going to have fewer spirits drinkers with less money to spend on them.
Lizzie, thanks very much. Lizzie Burden with a look at some of the stocks on the move. Another couple of stocks just to mention then, Tom, and I'll go to Deliveroo. That stock is gaining in the London session this morning. It's actually up by 7.3% this morning. That's on the back of news that we reported after the close last night that the activist investor, Sachem Head Capital Management, has taken a stake, often seen as quite an aggressive activist, and also suggests that perhaps takeover speculation will be rife for the sector. It has always not been very far from this sector, talking about takeovers, but apparently this activist sees Deliveroo as undervalued, and that is going to be something that is at the forefront of investors' minds.
Takeovers, not takeaways. Nicely delivered.
Oh, dear.
Anna,
That was terrible, Tom.
It was bad, wasn't it? Luxury. Let's switch focus. Move on quickly. Luxury space, LVMH. Oh, the fortunes of this company. They've been downgraded by Barclays, interestingly, in a note. Don't forget, back in April, the stock price for this luxury company was €895 on the optimism around the demand coming through from China, US and Europe, but Barclays has downgraded the stock and it's falling today. Well, in fact, it's flat right now, essentially, but it's downgraded on Barclays due to a lack of short-term catalysts. So we continue to watch that, and of course, the soggy demand coming through from China. Talking of China, Arm is important when it comes to that story. It's going to debut on the Nasdaq today. We're going to get the details around the biggest IPO of the year. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent €123 million to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth €123 million?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost €123 million and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Markets Today, 30 minutes into your European trading day. Let's get to our top stories. US core CPI picks up, keeping another Fed hike potentially in play this year. Markets shrug off the data, though. Razor edge rate decision. Will the ECB hike or hold as sticky inflation worries continue to swell? We're live in Frankfurt. Plus, open arms, long-suffering equity markets could get a major lift as the SoftBank-backed chipmaker debuts on the Nasdaq today in the biggest IPO of 2023. So, Tom, we wait for the IPO around ARM. That'll give us a sense of how much appetite investors have for tech, for the AI theme, for IPOs broadly. We're also waiting for the ECB, so there's a lot to wait for. But commodities looming large in terms of the equity market story this morning.
Commodities are up, energy is up. We've been talking about the fact that the oil price picture is looking challenging as well when it comes to inflation. And certainly that will be a factor for the central bank, for the European Central Bank, the ECB, when it makes that decision, of course, which many are finding very hard to call. And we've also seen, it's worth reminding viewers as well, we've seen that move lower. Manufacturing's been soft in Europe for a number of months, but in the last couple of weeks and months, you have seen that move softer PMI in terms of the manufacturing, and that's bled into services, and just pointing to the challenges for the Eurozone economy. How much of that is all factoring into the decision-making later today? Across your benchmark, gains of just 0.1%. So there's a bit of a holding pattern on the headline level as we await that decision. The DAX is down 0.2%, dragged lower by autos, and we'll look at that shortly. FTSE 100, though, up by 26 points. Comfortably above that 7,500 level, gaining 0.3%, and that is all about basic resources. Let's flip the screen and see what I mean when I'm talking about that, because you're seeing iron ore prices up, copper prices up as well, and the standout sector for us are the basic resources, and that's giving that lift to the FTSE 100, up 1.5% in terms of the gains coming through. The drag on the flip side, one of the biggest losers across these sectors, is the auto sector, and it's the part makers, it's the tyre makers like Continental that are weighing on this sector. Auto is currently down 1.3%, and that is a drag currently on the DAX over in Germany. Travel and leisure off by 0.4%. Retail taking a nosedive as well. Well, not a nosedive, but off by about 0.4% after the softness yesterday for that sector. Energy, though, back above 1% in terms of the gains that are coming through from that sector. And you're seeing Brent back above $92 a barrel as Javier Blas points to the fact that Arab Light over in Saudi Arabia is actually closing in to $100 a barrel. So it's energy standing out, basic resources as well, getting a little lift for the FTSE 100, gaining 0.3%, but the softness coming through for the DAX and the auto sector. Anna.
Okay, let's get back to the big IPO of the moment. ARM has priced its IPO at the top end of the range to raise $4.87 billion in what is the largest listing of the year. Shares in the British-based chip designer start trading on the US Nasdaq today at 2:30 p.m. UK time. For more, let's bring in Bloomberg's equity capital markets reporter, Julia Fioretti, with us with analysis on what this means for the broader capital markets story. Tell us about the details then of this IPO and the final valuation, because I feel like expectations have been well managed here, perhaps.
Yes, certainly, Anna. So expectations have been quite well managed. Initially, valuation ranges stretching up as high as $70 billion were being mooted for ARM. With the current pricing at the top of the range, it will be valued at $54.5 billion. So that is quite a bit lower. But it's also because there is a much smaller float, only 10% of the company is being listed, and SoftBank brought back about a 25% stake from the Vision Fund, so that it's holding on to more of the company, and this is enabling it to maybe temper the valuation a little bit, but list a smaller part of the company. It's still a hugely important deal for the IPO market. Globally, almost. A lot of people are looking at it. It's obviously a test also of the AI boom that we've seen, which has been powering this rally in the market. So a lot is riding on this offering.
Julie, does it open the floodgates then? How many companies are kind of piled up waiting to list? Is it really going to be that catalyst?
It's hard to say if it will open the floodgates. The expectations were already for a proper reopening to come next year as opposed to this year. That being said, if it does go well, if it does trade well today in the aftermarket, that will set the stage for other companies like VNG, Instacart, Birkenstock, which have all filed for US IPOs recently, and so which are waiting in the wings basically to launch. And there's quite a few tech companies as well. It's something we haven't really seen since 2021, and so a successful tech IPO will pave the way for others to follow, albeit at maybe more reasonable valuations than 2 years ago.
Yeah, it'll be interesting to see what it does mean for capital markets then. So if demand for this IPO then, Julia, was so strong, and that's certainly what the reporting around the story leads us to believe, why not price above the range? Why in market terminology, why leave money on the table? What does that mean for the start of trade?
Well, it shows that there's still some uncertainty in the markets, and also that SoftBank wants to ensure, or at least do its best to ensure, that there is a strong aftermarket performance, given that this IPO simply can't fail. There's so much riding on it. And it's always generally good to leave money on the table in IPOs to help sort of that aftermarket performance, and then to make investors money. If they don't, then they're unlikely to come back for other IPOs. And SoftBank also doesn't have a great track record with IPOs. Many of its past companies that have taken public have dropped below their offering prices. And so while SoftBank may have made money, the investors haven't. So it's important, there's a lot riding on this also just for SoftBank's reputation in terms of making investors money and carrying through a successful IPO.
Yeah, let's see if they can put that baggage behind them and have a successful IPO with Arm later today. The excitement certainly building. Bloomberg's equity capital markets reporter, Juliet Fioretti, thank you very much indeed. Now, Citigroup is preparing for a wave of job cuts. That's as Chief Executive Officer Jane Fraser launches the biggest restructuring of the Wall Street giant in 2 decades. Bloomberg's Sue Keenan reports from New York.
CEO Jane Fraser wants to change the direction of the bank's stock. Citi shares are down some 40% from when she took over as CEO back in early 2021, and that's more than double the decline of Citi's rivals. So this is a major shakeup designed to turn things around. Regional leadership roles are being largely eliminated, and Bloomberg has learned that some job cuts will result to back office positions. Executive ranks are being expanded, and 5 key execs will now report directly to Fraser. One of the key aspects of the revamp is that the company will now operate 5 main businesses, such as services, trading, banking, and the wealth unit. Bank analyst Mike Mayo says this should reduce the fiefdoms that have plagued the firm in lieu of greater cooperation. Citi stock rose on the day, and it's expected that the move will result in some departures and internal strife at the bank. Fraser conceded the restructuring was not going to be universally popular and would make some people, quote, very uncomfortable. She said she is, quote, absolutely fine with that. Fraser is the only CEO of the top U.S. Wall Street financial firms. She said her latest move is motivated in part by her desire to make her top executives more accountable as she tries to push returns on the stock to higher levels. Sue Keenan, Bloomberg, New York.
Coming up, the war of words heats up as China criticizes the EU for its investigation into Chinese EV subsidies. More on that next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The changes to the track are for trying to improve the race. Singapore is maybe not known to be the best race circuit. It's never a bad one. I think there's always overtaking. There's always, actually, I would say there's been some of the most exciting races here in Singapore. But it's still quite difficult to overtake. So I think it's something to try and make it even more exciting. But the little section that they took away was, for me, like one of the best sections of the circuit. So it's, in my opinion, a little bit of a shame. I liked how it was. But it's to improve the racing, is to improve the show for the fans, and I think that's the most important thing.
I mean, you've obviously taken a very important role in the team after Daniel Ricciardo's departure. In your mind, have you achieved everything you set out to do, and how strong is your commitment to McLaren until your contract runs out in 2025?
I mean, I'm dedicated to McLaren. I want to win races with them. I want to win championships. My position's not really changed.
Okay, so off the track, you've talked about some of the issues, how the sport can be more diverse, more inclusive, and it starts at a younger age. The younger you start, the better. What is the role you think you can play in kind of pushing that?
Well, I think you're right. Everything starts at a very young age now. There's 20 drivers in the world that can get to Formula One. So to be a Formula One driver for anyone in the world is very, very difficult. The hardest to achieve in any sport almost in the whole entire world. And out of, especially for boys and girls, there's just not enough girls who are coming into motorsport and into racing in go-karting at the minute. Out of every so many guys, one gets through into Formula One. And therefore the ratio of girls achieving this is just too little. So we need to get more girls to enter racing, enter go-karting. And I have my own go-kart. I have a good partnership with the team. And they're always very happy to try and improve and help girls come into Formula One or girls get into racing. Because it's not just Formula One that they want to achieve, it can be any sport, any type of racing.
How soon do you think till we see the first woman in Formula One?
I think even with this, we're closer than we ever have been, but it's a very tough question. I don't know. I want to say in the next 5-10 years, and it might sound like a very long time. Like 10 years might sound like a long time, but I think it's a realistic target because it takes, 10 years to go from karting to Formula One, roughly, almost 10 years, if you're starting at 8 years old, which is where we need to get more girls into racing.
Bit of hesitation there from Lando on the question of female F1 drivers. That, of course, was the McLaren 4-1 driver Lando Norris speaking to Bloomberg ahead of the Singapore Grand Prix this weekend. He was also a little bit critical of the changes to the track. From F1 to EVs now, and China has hit back at the European Union over its plan to investigate Beijing's electric vehicle subsidies. The chorus of criticism was joined by China's top auto industry body, while a leading Communist Party newspaper also suggested retaliatory steps could be taken. Let's unpack then what is an increasingly complex issue. Bloomberg's Germany correspondent Oliver Crook in Berlin. So the critique is coming, it's to be expected from China, Oliver, around what Europe is planning. What is how much fear is there about the actual China effect? And so they've been waiting a long time. They've been trying for many years to knock down the door of the European autos market. Why the fear now?
Yeah, so basically because they're really trying to get in now and to have this international expansion, so the Chinese OEMs have really focused on taking over China. They've taken more than 50% of the market share in China, and now they're looking to go abroad. And this was really front and center and the main topic that we had at the Munich car show last week. Have a listen.
I think almost a disruption.
Europe is our strategic market, and we want to try. We want to communicate with the customer here.
It's natural that new players are going to come in.
We're just entering the European market. We're launching our first 2 countries this year.
Competition drives you. We come from sports, and at the end, to be better than the competition.
There's a high competitive situation. That's good news for the customer.
We've already announced today the launching of pre-orders in Germany. And for next year, we're preparing, of course, Germany, Norway, Denmark, and France.
We're launching another 3 cars in Europe, in Germany, Netherlands, Sweden, and also Denmark.
We need to have competitive conditions. So electricity costs are high, salaries are high in Germany.
Let's embrace them and let's try to have a fair and competition to build ever better products for our customers.
And so clearly these Chinese automakers are really finding Europe to be kind of the hospitable area for them. VDL putting some cold water on that yesterday. What's interesting is to watch what the analysts are saying. UBS now saying that it basically, that this investigation, it's quite possible that the conclusion will be that the prices are actually just legitimately competitive and is not the effect of subsidies. And they're saying the consequence of this investigation may be that you, A, buy the dip on the Chinese OEMs is sort of the recommendation. Again, they still say you have to wait for it to play out before they're definitive about anything. But that Tesla actually accounts for 40% of Chinese EV exports. And also, it will probably accelerate the Chinese efforts to actually build local manufacturing in Europe to basically not have to deal with this issue anymore.
And I know that some of the analysts have also been pointing out, Ollie, that European car manufacturers post-COVID have been increasingly focused on value over volume, and then can't be all that surprised if other players try and step into the volume category. Let's put the spotlight on US car makers, though, because over in Detroit, we're going to get a strike in the US around the auto sector. Lots of people watching this as something that could have an impact on US GDP. What about from an auto's perspective?
Yeah, they talk about maybe being able to drag Michigan, the state of Michigan, into recession. So basically, you've had just weeks of negotiations between the Auto Workers Union and the Big Three, trying to get to sort of pay where they want it to be. The offer of 20% increase over about 5 years was rejected. They're looking for something closer to 46%, plus the COLA, the cost of living adjustment, which is basically inflation protection to salaries. And basically, they are still very, very, very far apart. And the problem is the labor contract expires tonight. So you will see likely beginning of partial strikes. So the union has kept it deliberately ambiguous to kind of hold their negotiating position, but it could start in sort of a partial factor. We're talking about 150,000 workers here, and eventually it could hit all 3 of the major car makers, which really would be an unprecedented event in the United States.
Oliver, thanks very much. Bloomberg's Oliver Crook in Berlin with the latest on the auto sector. Plenty of news there. Now, the former Treasury Secretary Larry Summers has also weighed in on the standoff between auto workers and the car makers.
I fear that there's a bit of an endgame dynamic going on here. Between the fact that electric vehicles take about 40% fewer workers per automobile, and the fact that a large part of the action in the automobile industry is moving to the southern part of our country, the UAW northern part of the industrial belt part of the country is going to shrink no matter what. And in that situation, the incentives for the union, like the incentives at one stage for the coal miners, like the incentives one stage for the steel workers, are to get as absolute much as they can while they can. And that, I think, is probably the underlying economic force behind some of the aggressiveness that we're seeing. And my guess is that this is going to be a difficult dynamic going forward for the economy.
And that was former Treasury Secretary Larry Summers speaking on Bloomberg's Wall Street Week with David Weston. Coming up, Treasury yields dropped despite the Fed potentially nearing the end of its tightening cycle. More on the markets coming up next. This It's Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
This is Markets Today, 8:52 in London, so 52 minutes into a trading day that has delivered this mixed picture for stocks. We're up by 0.4% in London, a bit more downside coming through in Germany and in Paris. Basic resources and energy stocks are the dividing line here. Those are pushing London higher. Autos and parts move lower. Consumer products and services also lower. Those play a little more negatively for Germany and for France. Let's talk about what's happening in the markets then. Ven Ram joins us from our Markets Live team. And Ven, let's take stock of what we heard from CPI, the CPI print, the inflation print out of the US, and what that did to market expectations around the Fed, because it was amazing. We got a slightly hotter print, not much, but slightly hotter. And if anything, the markets just kind of shrugged. I mean, there was a slight, if you were really looking for it, you could argue that the market priced slightly more cuts at the margin than before we got the CPI data. So what did you make of that data and how it landed in these markets?
Morning, Anna. The markets were looking for a big inflection point from the CPI data today. They didn't quite get that. So I think that interest rate pricing has been bobbing around these spring cuts in the spring 2024 kind of scenario, but I don't think that's happening. I think the message that we got from inflation yesterday was that core inflation is still sticky, is still accelerating on month. So I think that the Fed is going to have a hard time sending that signaling in when they meet next week. Obviously, they are not going to raise rates next week, but they are going to send a hawkish kind of messaging saying that, look, the economy is kind of resilient, the labor market isn't rolling over, so any talk of a rate cut is going to be premature. That's going to be the underlying message next week, I think.
Okay, so a hawkish message next week on the back of that CPI data, and of course retail sales out of the US later today, which could again give us some colour in terms of the pressure or not on the US consumer. When it comes to the ECB, then just give us your thoughts, Ben, on how this kind of plays out, the machinations of ECB officials, and maybe the role of QT as well as they think about the levers they can pull.
So in terms of the decision itself, obviously it's going to go down to the wire. I think that it's going to be the toughest call since they started raising rates in July. But I do think that if that Reuters report about revised inflation forecast being higher than 3% for next year is going to be right, it's going to be very hard for the ECB to look through that report and say, you know what, inflation is going to accelerate, but we are still going to hold rates. That kind of messaging will fall flat. But on the QT, I think the present plan is to let PPP repurchases continue, reinvestments rather, continue through the end of 2024. I don't think they're going to bring it forward, because if they bring it forward concurrent to a rate hike, that would be too hawkish for the markets to digest. So I don't think they will bring it forward. If they don't raise rates today, then they might bring it forward as a kind of a piecemeal rapprochement with the hawks on the council. But I think that's a bit of a pseudo-tightening, and that won't quite go well with the markets.
Ben Ram. Yeah, a bit of an alphabet soup, isn't it? I typed in PEPP just to make sure I had the acronym correct, and it came up with Peppa Pig. It's not Peppa Pig, it's the Pandemic Emergency Purchase Programme from the ECB. The details there, the analysis from Ben Ram from ALIT. Thank you very much indeed. Remember, of course, you can get up-to-date analysis and insight from Ben and the rest of the team. Just go to M-Live Go on your terminal. We are counting down to the ECB, but we have some important interviews as well coming up.
Yeah, absolutely. In terms of the global rate story, Richard Clarida joins the team, PIMCO's global economic advisor and former Federal Reserve vice chair, of course. Important to get his view on the CPI print. We've got retail sales coming up. Where does the Fed go from here? How long is the plateau? Key question for markets these days. That's coming up at 9 a.m. so shortly here on the programme. This is Bloomberg. Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Razor-edge rate decision, will the ECB hike or hold as sticky inflation worries continue to swirl? We're, of course, live in Frankfurt. U.S. core CPI picks up month on month, keeping another Fed hike in play this year, plus a boost for the Nasdaq as chipmaker ARM debuts today in the biggest IPO in the world this year. Also coming up on Bloomberg UK, my interview with the former UK Prime Minister Theresa May on Donald Trump, tensions with China and Brexit.
My biggest regret is not getting the deal I wanted to get through the House of Commons. And I think every Prime Minister leaves office feeling that there were things that they wanted to do.
So let's take a look at the European markets map. That the focus today firmly, of course, on what Euro is doing and everything to do with the ECB. It'll be very interesting to see Christine Lagarde navigate, of course, that communication. We keep on hearing it from many sides of the trading floor. This is probably the decision that would be most difficult for the ECB. Knife edge is what we've been hearing over and over now. On the back of that, stocks are a little bit mixed. Not only U.S. futures, but certainly European stocks. Little changed, Euro edging higher. Again, traders really bracing for this interest rate decision. It could be very close. There's evidence that Europe is facing persistent cost pressures that have, of course, been made worse by soaring energy prices, and then money markets pricing a 2/3 chance that the ECB raises interest rates by 1/4 percentage point. The other thing we're watching out for is, of course, ARM. We got the pricing last night. Today, trading will test appetite. So look out for ARM. A couple of other things we're watching out for. Yesterday's CPI print in the U.S. It did not rattle the markets too much. The tick higher in core CPI month on month at 0.27 is not too hot. And then the thirdly, of course, it's the ECB. So all will depend on what happens. It's knife edge. And of course, we're seeing a change in expectations. I think we have a beautiful chart. It's a beautiful Bloomberg chart that's coming up. There you go, probably the chart of the day, if not the week. So it is a knife edge for the European Central Bank, whether to raise interest rates for a 10th straight time or to pause. Let's go straight to Maria Tadeo, who's in Frankfurt. Maria, to hold or to hike? Good morning.
Francine, is a big question, but we're almost there. The suspense is almost over. And you would assume by 10 p.m. local time here in Frankfurt, we did see, by the way, this morning, Christine Lagarde was here in this building at around 7:15 in the morning, that this decision has already been taken and the Governing Council must have gotten to an agreement. This is now about fine-tuning that press conference. And as you said, Francine, this is going to be a difficult balancing act for the head of the ECB, no matter what they do, whether they hike or hold, even though the market, we should stress, is now positioned for a hike. A lot of that precipitated because of that story that came out by Reuters, then confirmed by Bloomberg, that those forecasts that will come out today in conjunction with that decision should see or should show that inflation would still be above 3% in 2024. And remember, that was a crucial year in terms of the transmission, the strength of the transmission that would dictate a lot of the behind the scenes of this decision today by the European Central Bank. But as I say, going back to this press conference from the head of the ECB, it is a balancing act. Of course, if they hold, there will be criticism as to why do you hold with projections that could show inflation sticky if they hike. But again, we've seen that there's already a downgrade for this year and next from the European Commission when it comes to GDP. But you also look at the PMI data, all of the data combined over the past 6 weeks, you do see an economy, not just in Germany, not just manufacturing, but actually widespread, that is heading into a downturn. So that would put a central bank that is hiking into a downturn that is palpable. This is a scenario they wanted to avoid, but they could find themselves today doing precisely just that, and that would maybe resuscitate the concerns about a policy mistake, the ghost of a policy mistake around this building of the ECB today.
Maria, thank you so much. Maria Tadeo there in Frankfurt. Now we'll have, of course, ECB's rate decision, 1:15 p.m. UK time, and we'll also bring you President Christine Lagarde's news conference shortly afterwards. Now joining us is Richard Clarida, Global Economic Advisor at PIMCO, former Vice Chairman of the U.S. Federal Reserve. Richard, what a day to have you on. I don't know whether you miss being a central banker, or whether at least you're just relieved you were never part of the ECB, because they have a tough time today.
I think they do. I think it is finally balanced, and I think your reporter did a good job checking off the issues. In fact, I would say now that apparently Bloomberg has confirmed that story, I do lean in the direction that I think they will go today. I do think it's finally balanced. I think President Lagarde was at Jackson Hole, and I did not take any particular lean But I think we have to take this report seriously. What I would say, Francine, is if they don't go today, I do expect them to go later this year. I don't think they're done. I think they're close to done. But the data in Europe has definitely been going south. And I think it is a balancing act.
Richard, is there a danger that actually central banks, in the eye of credibility, because they want to be credible because of what's happened in the last 3 years, will over-tighten? And then there's going to be a big slowdown as the effects of this tightening start taking ahead with the 12, 18-month laggard?
Francine, I think they want to avoid over-tightening, but certainly at the Fed, Chair Powell and other committee members have said many times the risk of doing too little on inflation exceed the risk of doing too much. I do think central bank credibility is paramount. I think so far credibility has been maintained. But yes, I think if there is a risk, and there's always a risk in the real world and policy, the risk will be over-tightening relative than tightening too little.
So what would you do if you were at the Fed today?
Well, I think today it will be appropriate to deliver what I would call a hawkish pause. They'll be moving next week, but I think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
And then stay for longer.
Yes, I think the new mantra will be, we heard lower for longer in the last decade, and I think restrictive for longer may become the new mantra, not only for the Fed, but for the ECB and Bank of England.
How risky is that for markets? They don't see, and we hear Christine Lagarde, we also heard the Bank of England governor, keep on telling the markets that we could be here for a while. They don't quite believe them.
They don't, and I do think that there's an element of disconnect. I've written about this before, that central banks will say higher or restrictive for longer, and markets will price in the cuts. Now, Francine, in the Fed's case, the Fed offers projections of its rate path, the so-called dots. As I learned as vice chair, you can't live without them, you can't live with them, but we're stuck with the dots. We'll get a new set of dots next week. And most likely they'll show, as they did in June, the Fed expecting that next year it can begin to cut back and to cut rates. But that will be a balancing act for the Fed, because the markets will tend to take what the Fed gives and then move it even further. So I think we'll see more of that.
Do you think, Rich, that U.S. bond yields have peaked?
Great question. We've been trading in a range really for about 10 months now. We've moved above that range. I'm still of the view that we're more or less in the range for treasuries that we're going to see. If rates do move up, I don't think it's going to be because of the Fed. It's going to be because of the fiscal dysfunction in Washington. So even though the Fed's very powerful, it's not the only driver of rates, and fiscal policy is also a factor as well.
But do you think we're underestimating the impact of QT? Like, we focus so much on interest rates, and this could be the big one.
Well, Jay Powell and the Fed's hope, Francine, is that QT operates in the background. In fact, I think Chair Yellen at one point said it's like watching paint dry. But as I learned when I was vice chair in the fall of 2018, it's in the background until it's not, and markets can suddenly start paying a lot of attention to QT. I don't think we're there yet, but it's obviously something the Fed will have to be attentive to.
So what do you think in this juncture in time? Is there something that markets are misunderstanding about what the Fed is trying to do, or how the economy will evolve?
I think the markets are underappreciating that the Fed has to take into account not only the baseline view, but the balance of risk. And I think there is a scenario next year where the labor market continues to be hot, low unemployment, the progress on inflation stalls. And at that point, the Powell Fed has a tough choice. Inflation's running, in the 3s next spring. They don't want inflation in the 3s. They want it heading to 2. And so I think markets are underappreciating that if inflation remains sticky and stubborn, in certain scenarios, we may see more from the Fed.
So you don't think they'll live with a 3% at the margin for a while longer?
No, I've said before, and I'll repeat on air, I think the destination before they start considering cuts is 2 point something on inflation, and point something might be 0.8 or 0.9, but they definitely want inflation year over year under the core measures in the 2s before I think they start thinking about what's next.
Richard, do you think we're importing deflation from China?
Well, certainly a surprise to me, although not to my PIMCO colleagues, because we got the call right. Typically, when you have reopening or stimulus in China, you do see it putting upward pressure on global prices. This year, inflation's going in the opposite direction in China. So, but you know, offsetting that, Francine, is the fact that we have a real push here for friendshoring, offshoring, de-risking, whatever the favorite term is. And that can only be moving in one direction. It's going to put upward pressure on prices as supply chains readjust.
All right, Rich, thank you so much. Richard Clarida, their Global Economic Advisor at PIMCO, of course, stays with us, and we'll talk a little bit more about fiscal space or the lack of. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back, everyone. Now, still with us, Richard Clarida, Global Economic Advisor at PIMCO and former Vice Chair of the U.S. Federal Reserve. Rich, thank you so much for staying with us. We talked a little bit about the Fed, bond yields, what you're expecting, maybe some of the pitfalls, and we're just getting started to talk about China.
Yeah.
What do we not understand well about the China economy that could actually hurt, I guess, even Europe a lot more? We know that no matter what political spectrum you're from in the U.S., you want to go after China. Does that translate economically?
Oh, it really does. I guess to answer the first part of your question, what do we not know about China? I think almost everything. It's an enormous economy, but it's opaque. It's hard to follow, I guess, sometimes even for folks in China. But clearly what we do know is that the reality of the 30 years before the pandemic, globalization, China supply chains driving global disinflation, you know, that's definitely in the past. We're in a world where we're going to have more complex regional trade arrangements, more complex trading arrangements, obviously supply of minerals, including lithium for batteries in China. So a very complex, not only economic, but geopolitical relationship, which all of us in markets are navigating.
But Richard, from where we are now, right, which is deglobalization and the onshoring of supply chains, how much more can that still go on? Are we really talking about a trend that can continue for years to come for deglobalization?
Oh, well, I would say more re-global. I don't think we're deglobalizing, but we're re-globalizing, for example, with our relationships with NAFTA, with Mexico enhanced, and some production in China moving to other countries. And so, yes, at PIMCO, we think this is what we call a super secular trend, which means, a decade or more.
So what does this mean? Going back to the U.S., are you expecting a soft landing, or are the chances of a recession quite, at 20%?
At PIMCO, we do think markets are a little bit over-optimistic on a really soft landing. I think I would characterize us as thinking of a softish landing, perhaps some modest rise in unemployment, perhaps a technical MBER recession, but not a deep, persistent a downturn. But we do think markets have gotten a little bit ahead of reality on the soft landing narrative.
Yeah. Do you think there's a perception across all, actually, jurisdictions that we've now, won the fight against inflation, and that's premature, be it in Europe, UK, or US?
Well, yes, because for the following reason, I think central bankers in particular will be very reticent to either communicate or even think themselves about mission accomplished. That doesn't end well, as we've seen historically, and in particular, given that central banks, including the Fed, and I was a member of Team Transitory, it's important for them to be darn sure that when they say that inflation's on the way back to 2%, it is. And so I do think that they've underestimated probably the resolve to keep rates restrictive for longer.
Why did we get transitory so wrong? It feels like, we could actually argue that it's transitory, but over years.
Well, I'm open to that since, as I said, I was a charter member of Team Transitory. Look, in the spring of 2021, what we knew at the Fed, and I was vice chair then, was that the vaccines had arrived, reopening was occurring, and initially the inflation that we saw was really concentrated in just a small number of reopening categories, used cars, for example. So I think what central banks got wrong, what the Fed got wrong, is that we had multiple large, unprecedented shocks. The pandemic was a shock. Reopening was a shock. Russia's invasion of Ukraine was a shock. And adverse supply shocks complicate monetary policy because they push up inflation, which is bad, but they also tend to depress activity, which is bad. And so I think it took a while, but I think the Powell Fed and the Lagarde ECB and the Bailey Bank of England recognized what they needed to do, and they're doing it.
How much do we need to start talking about fiscal space, right,
well,
of countries?
I think we do need to talk about it.
But markets are not really looking at it.
Well, I think they will start to look at it at some point because if you just look at simple measures like the amount of government debt relative to GDP, in most countries 20 years ago, that number was less than 50%. It's now around or north of 100%, including in the US, many countries in the Eurozone, not Germany. And I do think that fiscal space is going to be more limited going forward. Economists aren't very good at giving us the exact point at which you run out of it, but whatever your views were on fiscal space before the pandemic, there's less fiscal space available now.
And talking about fiscal space, we're almost at the one-year anniversary of that pretty disastrous mini-budget here in the UK.
Yes.
Are we over that? Is the UK feeling more solid?
I certainly, yes, I think, but I think that was a very important example of how quickly fiscal confidence can be eroded and how that can spill over into markets and require interventions. And so, yes, I don't want to necessarily invoke the canary in the coal mine analogy, but that may be the first of other episodes that we're going to see in the years ahead.
Could it happen elsewhere? Could something like that even happen in the U.S.?
Well, we've had disruptions in the Treasury market. In September of 2019, we had the repocalypse when the repo markets in the U.S. Were disrupted. Now, the Fed acted promptly in that case. We also saw the Treasury market challenged in the spring of 2020. I think we do have an issue in global sovereign markets in that the infrastructure for clearing and trading Treasury securities, for example, it was designed 40 years ago, and the amount of intermediation that you have to do in markets today is vastly larger. And so I think there is always the risk of hiccups and dislocations that cannot be completely eliminated.
Richard, as always, thank you so much for coming on.
Look forward to the next time.
Me too. Richard Clarida there, PIMCO's Global Economic Advisor and former Vice Chair of the Federal Reserve. Now, coming up, we'll bring you more on the year's biggest IPO. We're, of course, talking chip designer ARM. That's next, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
This is the Pulse. Welcome back. Now we're getting some breaking news out of Italy. The Prime Minister of Italy, Ms. Meloni, saying that the final tax on banks must net some 3 billion euros. So on the back of that, we're seeing a little bit of pressure across the board with, for example, Intesa Sanpaolo down 2%, Unicredit down 0.7%. Now, today is the day ARM has priced its IPO at the top end of its range to raise $4.87 billion in what is the largest listing of the year. Now, Bloomberg previously reported that ARM's initial public offering was oversubscribed by more than 10 times. Trading begins on the Nasdaq at 2:30 p.m. UK time. Now, for more on all of this, we're joined by Bloomberg's Sweta Gopinath. Sweta, thank you for joining us. I mean, it's a pretty exciting day. Like, we thought this would be a flop, and every day we have more encouraging news. So tell us the details about the IPO and really what we know about the final valuation.
Yeah, the final value is now at 54.5 billion. They've priced at the top end, like you said, which is actually a victory, really, for SoftBank, managing to get away with top-end pricing in this market where we've had few IPOs. The IPO market has been pretty depressed for the last 18, 20 months. So this is the big deal that we've been watching out for. And if it trades well today, it could really open the floodgates in a way we could see a number of other tech listings follow through. So it's a key moment for the global equity capital market.
And how sad is it for London that actually went to New York? There was a little bit of indication saying, well, it's half the price of what they wanted, but now it's doing so well. Is it really bittersweet?
It is a very bittersweet moment for London. There's a lot of hand-wringing here. Arm is a UK company after all, and to lose a tech giant like this to New York hits hard, especially because London has had so few listings this year. And we're not seeing the sort of pickup in activity we've seen overseas in the US. In the US, we've had a number of other filings already. We've had Instacart and Birkenstock file for IPOs, and we aren't seeing any of that activity here in London yet. So it's a sore loss for London, but a win for New York.
It certainly is, Sweta. Thank you so much for all of your extraordinary reporting, Sweta Gopinath. Now, coming up, my wide-ranging interview with the former UK Prime Minister Theresa May. We talk Brexit, China, Donald Trump, and the UK on a year on from Liz Truss. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, the former UK Prime Minister, Theresa May, has told us the economy is now stabilising after the tumult of the Liz Truss premiership. Well, hundreds of billions of pounds were wiped off UK markets during Truss's brief stay at Downing Street, which began just over a year ago. Now, in a wide-ranging interview to promote her new book on the abuse of power, May also defended her handling of Britain's EU exit, telling me her approach to Brexit was the right one.
I'm on record as saying I think my deal was better than the deal that was finally concluded. But I couldn't get my deal through the House of Commons, so somebody else had to go have a go.
Yeah, but you were also personally, you know, they said that you were maybe not as exciting as others. Boris Johnson proved to be very exciting, a little too exciting.
Well, I think it's interesting. It's one of the things that I think I took from my childhood. My father was a clergyman, so I was brought up in a country vicarage just out in Oxfordshire in the UK, and in that time I sort of learnt that I wasn't just myself, I was representing, in a sense, my father. People looked at my behaviour and sort of saw my father through it, and similarly the church. And it's a little bit similar in politics, that as an individual you're not just there as the individual, you're there as a representative of your party, of your government, and in international affairs of your country. And so I've always taken the view that one must be careful in the approach that I took to what I said and how I approached issues. And yes, some people said that wasn't very exciting.
But so does your style and the way you did business at the end, was it vindicated?
Well, I don't know. I mean, it's a different way of doing business. Okay. I think it had worked to get some results that I thought were good. Others had a different style and came out with a slightly different result. What we will see in the future, of course, is as the country moves on, how the country deals with the situation that it's on, and that's important for us now in our economy and business is to move on.
Do you think you were held to a different standard because you were a female leader?
I don't think. I mean, I think there was some different expectations. Some of the male colleagues would, for example, have said and sometimes actively said to me and openly said to me that when I was negotiating with the European Union, I should have been thumping the table, I should have been walking out of the room, I should have been slamming the door. Those very sort of aggressive ways of doing it. In fact, I had spent some years before I went into Parliament in a position where I was negotiating with the European Union, European Commission, and I'd learnt through that it was painstaking, slow, deliberate and careful negotiation on the details that got you where you wanted to be.
But has politics changed in the last 5 to 6 years? The way we communicate, the way diplomacy around the world, frankly, is done?
I think politics across the world has been changing in recent years. I say in the book, I think we live in a more absolutist world, a sense of you're either 100% with me or 100% against me. I think there are some in politics who find it difficult to accept the concept of compromise, whereas we know in politics, in business, in everyday life, sometimes you actually have to compromise. And I think there has been, in some senses, if you look at politics today, there's less respect than there has been in the past. Perhaps a coarser debate. I don't think that's good, and I think sometimes that puts young people off, which is not good for the future of our democracy.
What's your biggest regret?
Well, I have to say my biggest regret is not getting the deal I wanted to get through the House of Commons. And I think every Prime Minister leaves office feeling that there were things that they wanted to do. So some of the things I started have now been completed. I introduced a new Domestic Abuse Act, for example, which is now on the statute book. I did some work for a new Mental Health Act, which has not yet reached the statute book. We still have, that still has to be brought forward. So there are always things that, if you'd had a little more time, you hope you would have completed.
Did you feel at the time that the Brexiteers actually left it to the Remainers to get the job done because they didn't really have a blueprint of what they wanted?
Well, ultimately, I think some of them found it difficult to think that a Remainer, because I'd voted Remain, could deliver Brexit for them. And so, therefore, obviously, after me, they went for Boris Johnson, who had led the Brexit campaign and was a Brexiteer. And during the debates and towards the end of my time, we saw sort of hardline Brexiteers looking for a very hard Brexit, hardline Remainers wanting a second referendum to stay in. And that's why Parliament couldn't come together.
Do you think we'll ever get a second referendum?
No, I think the decision has been taken, and I have always taken the view that if you ask the people their view and they give you their view, you should act on that. I think it was the democratic will of the people that we left the European Union. But I think now what we must be doing is saying, actually, we've done Brexit. Let's stop thinking of life in terms of Brexit. Let's move on and look for the future.
The ex-M&S boss, Stuart Rose, says Brexit will be reversed within 20 years. Do you think that's possible?
Well, I think a lot of people, when they look at that, are thinking of, if you like, the current circumstances of the European Union. Over the next 20 years, the European Union is going to change. Its structures will change, its membership will change. So it will be a different body. The UK will develop over that 20 years. If you look back, there's always been an issue, even since we first joined the common market as it was then. There's always been a slight concern in the UK, an island nation, about this sense of being sort of attached to a group in Europe, and that came to its head for a variety of reasons in the referendum. I think part of that was part of the wider political sense that we've had across the world of people feeling globalisation hadn't been working for them, some people have been left behind, and people in the UK wanted their politicians to change.
But looking forward 5-10 years, could you see an arrangement where actually the two are closer together?
Well, I think what we've already seen, for example, the UK negotiating to rejoin Horizon,
Science, yeah.
I think is a very good example of a recognition that sometimes there are things there that it's good to be part of, that in relation to the EU. And I think over time we will see those, a number of areas. There were some areas on the law enforcement side, which I recognised as Home Secretary, where I hope we'll be able to get greater access to some databases and things like that. But I think there's a recognition now of the need to sit down and say, well, what makes sense?
Right, and what do you think makes sense? And again, depending on what happens at the next election, do you think that will again be on the table? If not another referendum, certainly closer business ties.
I think over time, governments will be looking to see what makes sense for economies on both sides, for the EU, but also for the UK economy and businesses in the UK as well.
Do you ever regret making Boris Johnson your foreign minister?
No, I was very clear when I set my cabinet that I needed to have a cabinet that was both Remainers and Brexiteers. The result of the referendum was clear, but it was close. And what I always wanted to do was to deliver Brexit, but a Brexit that recognised the concerns of the 48% who had voted to remain. Boris had led the Brexit campaign. I think, therefore, it was right that he was in the cabinet in a prominent role.
We've had quite an eventful, let's call it that, 12 months in UK politics, in UK business and UK markets. Do you think things have stabilised after the mini-budget of last autumn?
Yes, I think things have stabilised. I think Rishi, Jeremy Hunt being brought in as Chancellor, I think, was the first step, but Rishi taking over, obviously, as leader of the party and Prime Minister, with Jeremy in number 11, has stabilised matters. I mean, it's been difficult for economies around the world with the impact of the pandemic, and, we're all still coming out of that. But I think, and what I see, and what I hope markets and businesses see, is a UK government that recognises the importance of sound public finance.
Former UK Prime Minister there, Theresa May, with her takes really on the Brexit deal negotiations, Boris Johnson and the UK economy. Now, coming up, why Theresa May believes the Capitol riots were a wake-up call for the West and why China cannot be ignored. More from our interview with the former UK Prime Minister next, and this is Bloomberg.
Adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap.
as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
Welcome back. Now, we've heard from Theresa May on British politics, but she was also Prime Minister during the Trump presidency. Well, she told us the Capitol Hill riots was a wake-up call to the U.S. and other Western democracies that political stability should not be taken for granted. Well, we spoke to her about the UK's position on China, and that's, of course, as the government faces renewed calls to label Beijing a threat after the arrest of a parliamentary researcher on suspicion of spying.
You can't ignore China, huge economic presence across the world, although the Deputy Prime Minister identified it as the #1 state-based threat to our economic security. But it's a huge presence economically for businesses, but also, of course, in terms of the way it has reached out across the world, sometimes being able to take a position in countries because the West has not been there. So we should learn from that, I think. But we have to balance. There are real human rights issues with China. You know, I'm involved in setting up a global commission on modern slavery. If you look at the recent Global Slavery Index, it identified solar panels being created in China and labor exploitation behind those. So we have to look very carefully, and businesses can make a huge difference in looking at their supply chains.
But at the moment, do you think we're too hard on China? And is there a danger that if you look at the template of what happened with Russia in the Cold War, we're repeating that with China today?
Well, I think what was interesting if you think about Russia and the Cold War, is in a sense both sides knew where the dividing lines were and were able to, there was an existence that was able to go into the future with people understanding those dividing lines. And I think maybe we haven't quite got to that point with China. It's very interesting if you look at somebody like Kevin Rudd, former Australian Prime Minister, who's very knowledgeable on China. He sets out that as one of the potential ways forward.
President Trump had given you a hard time. What do you think a second presidency, if he wins the next election, means for the world?
Well, I'm not going to speculate on the result of an American presidential election, or indeed on the result of parties' candidates and who they choose for candidates. I mean, what I would say is that it was, I would say, a presidency like no other. When we saw President Trump in his position, and it was a more unpredictable, perhaps an uncertain presidency. I think what we see now, and in a sense the war in Ukraine has helped with this, is America again, with its Western allies, standing up for Western values.
But do you see abuse of power in the US?
What I worry about in the US is the polarization of politics, what I would say the very hard line polarization of politics. And I, as many around the world in democracies, were deeply concerned about the mob attack on the Capitol and what that meant for democracy. And I think it in a sense, was a wake-up call, because in recent decades, I think those of us in the West have taken the view that liberal democracies were in the ascendancy, that this was an accepted way forward, and we almost didn't need to worry. We became complacent. Actually, we have to fight. We have to work hard to protect democracies and to persuade younger generations in our own countries of the importance of democracy.
But are these cycles in the politics and foreign affairs of the world, or is it social media?
Well, I think you can argue that politics does have its cycles. If you look at the economic situation, many would say, I referred to the 1970s, many would say we're seeing that sort of cycle. But I think that my own view of social media does have an impact on these issues in terms of the nature of political debate. And I think it means that somebody whose views normally would perhaps be dismissed or not listened to can promulgate those views across social media, and other people similarly thinking will respond. It becomes a worldview, and the danger is that people only listen to people who have the same views as them and don't enter into what we need in politics, which is a respectful and serious debate, because we're all facing some really tough issues.
In your book, you talk about concrete examples and you unpick the kind of abuse of power. Do you think it will get worse before it gets better?
Well, I hope that having written the book, having, if you like, shone a light on this issue of the abuse of power, that actually people will start to say, yes, there is something there. What can we do to have a different approach? I mean, the fundamental of the book is that, I start off by saying in an interview I'd said that being Prime Minister was not a position of power, it was a position of service. I think all those who are in politics are there in a position of service and should never forget that.
So why do young people not want to join politics? How difficult is it because you get dragged through the mud? I mean, politics was always a dirty business, but what you're also getting at is that it's maybe harder now than it was 20 years ago.
I think that for a lot of young people, I think that the world is different to the world that perhaps I grew up in. I think there is an element of some people who don't go into politics, particularly, sadly, women who don't go into politics because of the bullying, the harassment, the threats on social media, for example, and feeling that that's not something they want to be part of or one of the recipients of. I think also for young people, often these days, they're having to cope with some with really difficult times. I think we do see a younger generation who are now worried that they won't be better off than their parents. You know, we've seen through time, every generation has hoped that its children will be better off. But now, you just look in the UK, how difficult it is for young people to own their own home, for example. As I said earlier, the impact of higher interest rates, of inflation, has been something they haven't had to cope with before. And I think that sort of day-to-day managing and a feeling perhaps that the politicians haven't responded to those needs, perhaps also is an element of putting them off politics.
Former UK Prime Minister Theresa May, they're sitting down with us for that wide-ranging interview. Now, more ahead on Theresa May's views and her legacy as Prime Minister. We'll get the take of Bloomberg Opinion's Adrian Woolridge. That's coming up shortly, and this is Bloomberg UK.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make
Bloomberg UK, your your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
In the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Look at the aggregate GDP numbers, it's going to be slowing. You can't escape that. The demographic drag is going to be enormous. But if you look at the individual income levels, it's going to be continuing to steadily rise because productivity is getting higher. China's getting smarter. They're going to be able to make EVs. They're going to be able to make smartphones with more of their own internal components and so on. So to come back to your question, Francine, do they care about this? Yeah, they care about it. Like, bragging rights are important. They'd love to overtake the United States. They'd love to regain their historical position as the world's biggest economy. But if individual incomes are still rising, if people are still getting better off, if they're still willing to make that kind of Faustian pact with the Communist Party, that the Communist Party can stay in charge because they're still delivering rising prosperity, I think that's going to be okay from Beijing's perspective.
Well, that was Bloomberg Economics' Tom Orlick on the impact of China's slowing population, whether it cares about overtaking the U.S. economy. And yes, we've moved it to the 21st century. You can watch now, not only listen to the full conversation of the In the City podcast that I host alongside David Merritt, but you can actually watch it. You can listen to it on Apple Podcasts, Spotify, or wherever you get your podcasts, and be sure to subscribe. It dropped today, but you can also look at it on YouTube. Now, let's return to our interview with the former UK Prime Minister, Theresa May. Here with me for his take, one of the smartest minds when it comes to historical UK and, of course, putting it into what we could expect from the UK in the next 20 years is Adrian Woolridge from Bloomberg Opinion. Adrian, first of all, congratulations on all your columns. I really enjoy them because they always have a little bit of a different take, so I urge everyone to really go and listen to them. Theresa May was interesting because she has a book out, and really it's a good time to reflect on what she lived through. And I guess the question is, will we ever see a politician like her again rise to the top?
I think yes and no. I mean, no in the sense that she's a very, very awkward person, and she's really a sort of senior civil servant rather than a politician. She was sort of miscast as a politician. But yes, in the sense that she's a pragmatist who's trying to find practical solutions to practical problems. She's not a sort of person who relies purely on charisma like Boris Johnson. I think we're moving back in a more charismatic direction. So Rishi Sunak is a better retail politician than her, but he's essentially a technocrat, a pragmatist. So that mold of sensible people being in charge rather than, well, Boris Johnson, who I don't think anybody, even his friends, would characterize as sensible, I think we're seeing that twist in politics, that turn in politics.
Adrian, what was your main takeaway from the interview? I kind of, really cast my mind back to some of those backstabbing moments and horrific moments, but then she left and it was even more chaotic.
Well, I think that the cliche about Theresa May is that she was delivered a very bad hand and she played it badly. And I think that's a cliche because it is correct. It was an incredibly difficult time, partly because the country was divided right down the middle, slight majority, but only a slight majority for Leave, and partly because we hadn't planned for what to do after Brexit. They were selling us the levers, which is one reason why they won. They were selling us a blank check, and everybody filled that check in according to their desire. There was no plans in the civil service, no plans, I think, in Boris Johnson's head as the leader of the Leave campaign as to what to do afterwards. So she had to deliver on a set of promises. She tried to do it by balancing the two sides. The two sides weren't really in a mood to be balanced. And also, as a salesman, she was very weak. She was very weak for two reasons. One, that she's just not very good with people, and so she couldn't build the sort of coalitions she needed to build in Parliament. Nobody feels as though they know her. And secondly, because she didn't make a case. I mean, an intellectual, compelling case for why both sides needed to come together to produce a synthesis, to produce a compromise position. She started off by saying Brexit means Brexit, and I don't like all these people of nowhere and all of that sort of thing, and then tried to move back to the centre. But never did she really say, look, the nation has to come together. Both, we have to compromise. People can't have exactly what they want.
Adrian, very quickly, I was surprised, actually, that she didn't throw anyone under the bus.
During the interview.
Were you surprised?
I am a bit surprised. I think what we have in this country at the moment is a market. We have too many ex-prime ministers trying to sell books. Even Liz Truss has a book deal in which she's trying to sell a book on how to save the world in the next 10 years, which, given that she destroyed the British economy in 47 days, I don't know what she'd do to the whole world in 10 years. But nevertheless, I think if you're selling books and selling yourself as an ex-prime minister, you need to give the people something. And she didn't really do that.
Yeah, scandal. Adrian, thank you so much,
Thank
as
you.
always, for joining us. Bloomberg Opinions, Adrian Wooldridge there. Now, up next, the Bloomberg Surveillance Early Edition continues. Sonali Basak in New York. Our Danny Berger is here in London, and this is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today: to hike or hold. It's decision day at the ECB. Bloomberg is live in Frankfurt as the cliffhanger looms. A NASDAQ debut for the largest listing of the year. ARM priced its IPO at the top end of the range, and now the stock starts trading today. And more drama at Goldman Sachs. The bank abruptly fires executives at a unit it's been working hard to grow. Good morning and welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London with Sonali Basak in New York. Sonali, this isn't an I told you so, but I did say yesterday that the ECB would be more exciting than the CPI. And the CPI, I mean, the reaction, we got to admit, was a little bit of a snoozer.
I wish I was there to buy you a drink one time after the show, Danny. You have been talking about you winning this bet all week. I do want to talk about S&P futures, though, because it is a beautiful day here in the United States for an IPO. You are looking at the S&P 500 futures up 0.2%. Remember, volatility is also quite low. We are below the one-year average on the VIX, and so the S&P is looking green, but again, a lot can happen in a morning. We will watch for that ARM IPO to start trading. It will mean a lot for investor sentiment into new stock. Now, the two-year yield, 498. Now, that looks low relative to what we've seen earlier in the week. I do want to talk about the volatility we've seen here, even with a 1 basis point move in the two-year yield. The amazing thing here, Danny, with the two-year is that it has moved intraday over the course of 3 days, 12 basis points from a range of 495 to 507. So we will keep an eye on that throughout the day. The U.S. dollar finally getting some relief. We have known that that has been hot for the last week or so. Brent crude at a 92 handle. I would also point out that WTI is flirting with 90. This move in oil, 7 basis points higher, or 0.7% higher, in Brent crude. We will talk about that oil story more on the show today.
Yeah, we definitely will, and how it relates to inflation. Sonali, I should say, or at least to our viewers, my bet is not with Sonali. It is with producer Dan Curtis. I said a week ago that the ECB would hike today. Back then, we were pricing just a 33% chance that they would hike. So even if I'm wrong, the market has moved in my direction. I'm pretty pleased with myself about that. Even so, it's remarkable to look at a euro that hasn't really moved much as this market has kind of gotten hawked up. Euro versus the dollar still at 107, barely moved today. Not a lot of stuff is moving today. We got to wait for that ECB decision. Two-year yields, those not moving either at the moment in Germany. Again, we're pricing above a 60% odd that they will indeed hike today, but economists surveyed by Bloomberg, the majority of those do believe that they will hold. We'll talk to Callum Pickering later in the show, who also believes that it's weighted towards a hold today. Finally, European stocks really just being supported by basic materials and energy because of what you pointed out, Sonali, those higher oil prices. But on a headline basis, barely moved to slightly higher.
Now we've been talking about it. It's that knife's edge decision today from the European Central Bank on whether to raise interest rates for a 10th straight time or to pause. Bloomberg's Maria Tadeo is standing by at the ECB in Frankfurt. Maria, hike or hold?
Hike or hold? That's a very good question, but I also like to say, Danny, yes, she agreed it was a hike a week ago, but I also sent her an IB. I remember this very well, saying, I don't get it. I don't understand why the market believes they're going for a hold. And again, this takes us now to this decision where the market sentiment, once again, it has been a roller coaster 3 weeks, actually, in terms of pricing, now is positioned for a hike today. We should note, and the context here really matters, is that today we get a monetary policy decision, but we also get new economic projections, including including inflation. And this change in sentiment has been precipitated by that Reuters story, then confirmed by Bloomberg, which says or predicts that in the new forecast, the European Central Bank will still see inflation above 3% in 2024. And the reason why 2024 matters is because that was seen as the key year, as a crucial year in terms of transmission. Remember, the whole decision hinges around the idea of transmission being effective, being operation. There is a lag. We know obviously that happens with monetary policy, but if you believe that transmission had done its job, then you could argue there was a hold. Having said that, if you look at inflation and it doesn't transmit or it doesn't reflect that strength in the transmission, there was still a case for a rate hike, and that takes us to today, the market position for a new hike from the European Central Bank. 10th consecutive should take deposit rate to 4% and leave Madame Lagarde with a complicated communications exercise in that press conference.
Yeah, and Maria, we should also know you have really been questioning the consensus of a hold, and now it's no longer consensus. You were out in front on this.
I did.
Now, yeah, it's true. Maria gets a victory lap today. Now, beyond the monetary policy decision, the ECB really is facing an increasingly difficult outlook. As you've been laying out, how difficult will it be for them to avoid a policy error?
Yes, and look, the ghost of a policy error, perhaps of the past, permeating in this building. Look, whatever happens today, whether it's a hold or a hike, and again, we should notice we say that the market is positioned for a hike, there will be pushback as to what led to that rationale, because when you look at the data, you could argue both things. This is a single mandate central bank. Of course, if you see inflation above 3% also heading into next year, then that would merit a hike, but you also have to factor that obviously there is an economic context, and in those same projections, you could get a downgrade to GDP growth. Remember, the European Commission at the start of the week already downgraded the GDP expectations for this year and next. There is a palpable decline in the European economy. And it's not just Germany, it's not just manufacturing. When you look at the indicators that we've had over the past 6 weeks, they point to widespread concerns and weakness, not just, again, in the biggest economy, but really spreading across the euro area. Nonetheless, if you go back to the hike, it is a single mandate central bank. And of course, they always said they would look into that data point, and they would look also into the dynamics that would certify, make it clear that inflation is going down sustainably to that 2% target. It is a challenging communications exercise for the head of the ECB. Again, if you assume they hike today, they would be hiking into a downturn. Again, that's a difficult scenario for any central bank, and it is a scenario the ECB said they wanted to avoid when they started hiking.
All right, Maria, we're going to let you go. You got 3 hours to prepare for the big decision. Maria Tadeo there reporting live from Frankfurt at the ECB. And stay with us with Bloomberg for the full coverage of that decision. Again, 8:15 a.m. Eastern time is when it's going to hit. All right, the other big event today. It is ARM's NASDAQ debut. It priced the IPO at the top end of its range to raise nearly $5 billion in the latest listing of this year. Joining us now is Bloomberg Deals reporter Sweta Gopinath. Sweta, what details do we know about this IPO so far? When it's going to list today? What are we looking out for?
It's a record-setting deal, really, and it's a big moment for global equity capital markets, which have been depressed for a good 2 years almost now. This is the deal that we've all been watching, and today is the big day, of course. The price at the top end of the range, it's valued at about $54.5 billion. It's the largest listing globally this year. It's the largest U.S. listing since 2021. So it just tells you about the state of the market. We haven't had deals of this size come through. And this could very well sort of open the floodgates for other tech listings, if it goes successfully, of course.
I guess I'm a little skeptical. There's a sense here that this can reopen the IPO markets at a greater scale. However, the reality is we're sitting here in the middle of September. The window for IPOs is very small. If you're going to list, you really need to file pretty soon. So how significant is the ARM IPO for the broader equity capital markets, or is it a standalone?
It's not, I mean, it's a standalone in the sense that we don't really have deals of that size, globally speaking, right now. But in the U.S., we've seen at least 3 other S1 filings over the last couple of weeks. We have Instacart, we have Klaviyo, we have Birkenstock, all looking to list. So it's sort of the green shoot of a rebound, and I think it's most pronounced in the U.S. Really, we're not seeing any of that here in Europe. In Europe, it's pretty much still a very depressed market, and Birkenstock going to the U.S. That's actually another loss for the European market, coming just on the back of Arm's big loss to London.
So here's my fun fact of the day. Sonali Basak wore Birkenstocks into the office today. That's how committed she is to the IPO market. And we've now decided that that's her permanent outfit for IPO day. Sorry, Sonali, you're stuck with it.
I'm all about it. I think it's a really good ritual, actually. It's better for your feet, too.
Yeah, everyone please write in and petition for Sonali to also wear them on air. Hey, Sweta, thank you so much for joining us. Bloomberg Sweta Gopinath there on the ARM IPO. All right, let's turn to banking now. Goldman Sachs has fired transaction banking executives, including the head of the business, Harry Morthy, over compliance lapses. The abrupt ousters hit a unit that the firm has been working hard to grow. Joining us now on that is Bloomberg finance reporter Will Shaw. Will, what happened here, and what is the wider context for this business unit?
Yeah, so Harry Morty's career with Goldman Sachs is effectively over. He was fired for unauthorized communications on unauthorized channels and failing to cooperate with an internal probe. He was fired along with several of his colleagues. It's a big blow for that part of the business, which, like you say, Goldman Sachs have been keen to grow. In fact, the chief executive, David Solomon, singled it out in February, saying effectively it was at the beginning of its potential to deliver more for the bank. Ultimately, Wall Street banks just can't take a risk on things like WhatsApp communications anymore. Last year, US regulators reached a settlement with about 12 banks that included Goldman Sachs for failure to monitor these kind of communications, and that took the total penalties for this kind of conduct to over $2 billion. So nobody is taking any risks on this kind of thing at the moment.
I want to switch gears and talk about Citigroup for a minute, because that announcement that they had made yesterday, this global campaign to really shrink the layers of management across the world, how is that going to change the texture of the bank, and how is the news kind of staff?
So, in fact, this is the biggest revamp at Citi in about 2 decades. What Jane Fraser's trying to do effectively is reverse a years-long slump in the stock price. So the bank will now operate 5 major businesses. 3 regional chiefs will be eliminated. They were overseeing about 160 different countries. So it's really big reform that we're talking about here. There are pros and cons to what's happening. Mike Mayo, he's an analyst at Wells Fargo. He was telling clients that this will reduce fiefdoms, which have plagued Citigroup in the past. In fact, its staff numbers have ballooned to around 240,000, which seems like an incredible number. At the same time, Mike Mayo warned this kind of thing can cause unanticipated exits, the departures of people that you'd rather would stay, and there's a risk of it causing internal strife. So I think we'll just have to see, we'll have to keep watching, see, is it going to turn into a bloodbath? Will it all proceed smoothly and lead to the reform that Jane Fraser would so like to see?
Our thanks to Bloomberg's Will Shaw. Now, sticking with banking, UBS is planning to move its investment banking and trading operations to Credit Suisse's New York offices as the Swiss banking giant continues to integrate its former rival. Now, Danny, the reason I bring this up is this is the iconic 11 Madison building in Flatiron, Manhattan, very trendy, and also with the comeback to people in New York. It will be interesting to see investment bankers both at Credit Suisse and UBS flooding that building while the wealth managers hang out over on 6th Avenue.
I was going to say, isn't that 6th Avenue office like kind of close to Times Square? It's been a while since I've lived in New York, so I feel like my New York geography is kind of off. But yeah, I would take Flatiron over 6th Ave, I think, any day. I don't know.
You have a very large difference, let's say, in eating locations and restaurant choices. I would say they're a little better by 11 Madison, but you know.
Yeah, get a little bit more trendy, move downtown. That's great. Exactly. All right, coming up, we're going to talk about that ECB rate decision. It's coming up in a couple of hours. We'll push ahead to that with DZ Bank Sonia Martin. And Berenberg senior economist Callum Pickering will be joining us later this hour. Does he see a hike or a hold? This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Shonali Basak is in New York. So we have, 7 of the 10 major currencies, their central banks are going to be having rate decisions over the next week or so. Today, it is the turn of the ECB. But a lot of what this brings into question is what happens with the dollar next. There's been a lot of calls for the demise of the dollar, be it because of Asia currencies, maybe another ECB rate hike. Let me just take you through what the dollar's been doing. I have for our radio listening audience a chart of the Bloomberg dollar spot alongside its 20-day moving average. We have been solidly below that for most of the year. Now, only just recently in August did we get this pickup above the 200-day moving average. But if you look all the way over here in the last part of my chart, it does seem to be turning ever so slightly. So has the momentum of the dollar run out of steam? Are central banks around the globe going to take the gains of the greenback and undo them? Let's get now to Sonia Martin, head of currency and monetary policy research at DZ Bank. Sonia, the dollar, can the rally continue?
No, I think, we've seen a fairly big correction. If you look at euro dollar, just in, June, July, we were trading around 111. Now we're down 107 in that area. So we have seen a sizable correction. The dollar has really benefited during this time from the increasing optimism on the U.S. economy. People have become almost euphoric. It wasn't just the pricing out of the recession. It was a pricing in almost of a very optimistic outlook, which I believe is overdone. And as a result of that, I don't really see the dollar gaining more ground here. I think we've probably reached the end of that correction, and looking in the sort of towards the end of the year, I would expect the dollar to be weaker and for euro dollar to trade higher again.
Well, what is the risk that that goes the other way, that correction continues pretty meaningfully?
Well, the biggest risk, factor is, of course, the fundamental development at this point. If the U.S. were to continue to surprise on the upside, and it would take quite a lot to achieve that. But if the U.S. economy were to prove even more resilient than what people are pricing in right now, if, the labor market doesn't soften, that could, of course, change the narrative. And, conversely, if you look at Europe, we are in very weak economic territory right now. And we'd need, I think, some significant downside surprises, even from current already low levels, for the euro to continue to decline. So it's a risk scenario. It's not one I necessarily share.
How does 2024 play out? Because on one hand, we are talking so much about the rate decision today. On the other hand, you're seeing this divergence really start to emerge among monetary policies between the U.S. and Europe and across the world. So how does that play out into next year?
Yeah, I've said on these programs before, I don't quite understand why we are so obsessed with this last rate hike, come or not. I mean, if the ECB hikes or not today is not going to materially change the outlook for the European economy, and it's certainly not going to impact the price I pay at the gas station when I go there next week or in 3 months for that matter. The focus should really be shifting towards next year, and we're going to see quite a big divergence next year because, we do expect the Fed to cut rates by the middle of the year. Sometime in the summer, we're probably going to see the first rate cut. They have hiked very aggressively. They tend to then start cutting fairly quickly. And once they start, they usually deliver, continuous rate cuts. And when you look at Europe, it's a bit different because in Europe, we have the ECB, which is likely to remain very restrictive throughout most of that year. So we're expecting rate cuts from the ECB at the end of the year. And that divergence should allow euro-dollar as well to move higher throughout next year. Although, given the economic fundamentals in Europe, I'm not going to be too optimistic. I mean, we have a 112 euro-dollar forecast, which, really isn't particularly aggressive.
Yeah, because, I mean, even if you look at what's happened month to date so far, Sonia, where we've got that pricing coming of a hike today, the euro is actually weakened so far in September. Yeah. So you say the hike today, if there is one, it's not going to make that much of a difference, which I totally agree with if we've already had 425 basis points of hikes from the ECB. But is there anything they could say today that would lead to a sustained strength for the euro, or is it all about what happens next year?
Well, unfortunately, I think part of the problem today is going to be that once the meeting is behind us, and that might generate some volatility intraday, we're going to start talking about the Fed next week. So, we're sort of moving from one event to the next, and there's a lot of uncertainty in the market. Could the ECB do something today? Well, I think if they were to be very hawkish in the statement, plus a rate hike and potentially signal that there might be more in the pipeline, that could change the narrative in terms of euro-dollar, and we could see the euro moving higher on the back of that. I don't necessarily think that's going to happen. I think the more likely scenarios, in fact, I do believe they're not going to hike rates because they don't need to. I believe they have so much in the pipeline, and they could adjust forward guidance on their reinvestments under PEP. That's a hawkish signal. So I think it's going to be a very hawkish signal, but I think they would have to deliver both words and action in order for the euro to benefit today lastingly from this meeting.
Sonia, what are the chances that the demise of the dollar strength comes from Japan?
Well, I mean, obviously, a lot of people have been discussing this issue. What happens in Japan if monetary policy changes in Japan, then yields in Japan will rise, and that's going to trigger some sort of, repatriation of capital out of the U.S. back to Japan. I mean, the story is not completely without its merit. Obviously, we all know Japanese investors are massive holders of U.S. Treasuries, and there is a risk that there'll be some repatriation. Having said that, I mean, when you look at the yield differential, even if the yields in Japan do rise, they're still going to remain well below what you get paid elsewhere. And if you look at the US, once the curve begins to normalize next year, hedging costs for Japanese investors in the US are going to normalize as well, and it'll still be attractive. I mean, there might be some drain, but I don't think it's going to be as massive and as detrimental to the US dollar as some people have sort of suggested that it might be.
Hey, Sonia, we got to leave, but quickly, before we let you go, because we got to ask everyone today, hike or hold, what does the ECB do today?
Hold.
All right, love it. Sonia, final word there. Sonia Martin of DC Bank going with a hold. All right, coming up, a growing chorus of supply warnings push oil to a 10-month high. More on that next. This is Bloomberg.
news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Sonali Basak in New York. All right, a quick check on oil because prices have climbed to a 10-month high after the IEA joined OPEC and the U.S. in warning of a supply shortfall through the end of the year. Sonali, there's a really interesting argument to be had, which Mark Cudmore from the MLive team makes, that higher oil prices won't actually lead to more inflation. Instead, it means consumers feel the pinch even more and spend less, i.e., lower growth.
Well, that's interesting, too, because these prices that we see today are on the rise despite slowdowns in other parts of the world, like in China. But the futures action is showing you that there might be some more pain ahead when you look at the supply picture here.
Absolutely. Okay, coming up, we're going to be speaking with Berenberg's Callan Pickering as he leans towards a hold for the ECB today. This is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. To hike or to hold? It's decision day at the ECB, and Bloomberg is live in Frankfurt as the cliffhanger looms. And a NASDAQ debut for the largest listing of the year. ARM priced its IPO at the top end of the range, and now the stock starts trading today. And more drama. Over at Goldman Sachs, the bank abruptly fires executives at a unit it's been working hard to grow. I'm Sonali Basak in New York with Danny Berger over in London. Danny, tell us about the European markets today.
Well, why would you move? Why would you put any risk on? Why would you bet on the euro or the dollar versus the euro at a moment when we're just 3 hours, less than 3 hours now, away from an ECB decision where the market pricing has moved a whole heck of a lot? Last week, 25% chance that they would hike. Today, it's about 60% chance. At the moment, we're looking at a euro, though, that is little moved on that change in pricing. Sonia Martin from DZ Bank said that she expects the euro to go to 112, but not until next year. So we're not moving much there, not moving much on yields either. Front end of the curve in Germany, just ever so slightly lower, but again, not a lot of movement. When it comes to European stocks, we are seeing action here, higher by about 1/3 of 1%. But Sonali, that's really just about the energy complex. Oil is moving higher, some of the metals are moving higher, so the best performing sectors there are energy and basic materials. How's the U.S. session shaping up?
You know how before, about a half an hour ago, I told you it was a beautiful day for an IPO to open here in the United States. It's ever so slightly more beautiful. The S&P futures up now 0.3%, calm as ice when you're looking at the volatility on the day. The more volatility you've been seeing intraday is in that 2-year yield. However, even there, you're getting a slight bid in bonds. You're looking at a 497 handle. The Bloomberg Dollar Index finally cooling off just a little bit, not all that much, but it is about plateaued since the levels we saw last week, slightly lower. Brent crude, this is what is on the rise. WTI flirting also with 90. We are going to keep an eye on that because longer term, this is where your worries about inflation start to seep in further ahead of some key decisions we're hearing by central banks.
Right, and what is central bank reacting to that? Really just kind of be a gut punch, maybe not well thought out reaction, but it's the main event of today. It's the ECB's dilemma over to whether deliver a 10th straight rate hike or pause. Now, the meeting will definitely be a cliffhanger. 34 economists surveyed by Bloomberg predict to hold, 32 see a hike, but the market is leaning towards a hike. Joining us now is Callum Pickering, senior economist at Berenberg. Callum, we got to start there. To be honest, a beer in my life, whether I pay for one or get a free one, rests on the ECB hike today. So really big stakes for me. Do they hike or hold?
It's always good to get a free beer. It's going to be a close decision today. I think the market will know today what the top 4 rate is. If they hike, I think they're done. If they don't hike, I think the market will understand why. They can say we've downgraded our forecast. We've got lots of lagged impact of past monetary policy hikes to feed through. The manufacturing data are awful, the construction data are awful, and services is turning down. And so I don't think the market will worry that the ECB is leaving monetary policy too easy. So today I think we find out a lot of information, and market prices, I think at the end of the day, will reflect what is likely to be the realistic scenario then for the next 6 months.
Yeah, I'm going to be honest, sounds like you're leaning slightly towards a hold, which worries me because that means I have to pay for someone's beer. So I'll send you the bill, Callum.
We're leaning towards a hold on the basis that central banks do not want to cause policy-induced downturns.
But would this, though, it's only 25 basis points when they've already gone 425. Would this be a policy mistake, just another 25 basis points?
Monetary policy is already restrictive in the Eurozone, and the balance of data have surprised to the downside recently, which means you don't just have the 25 basis point to think about, you have the 25 basis points in context of economic data which may be worse. And what we've actually not seen yet across any parts of the advanced world is through this interest rate cycle, the phenomena of a panic about interest rates. And quite often what you see is towards the later part of interest rate cycles, people then start to panic. The other thing I would just keep in mind is central banks habitually cause recessions by tightening too much. So that's the question that markets should be asking now. Are we tightening into an unnecessary recession? And in hindsight, it's obvious, well, central banks went too far. At the moment, for the most part, when central banks are raising towards the end of the cycle, markets think it's okay, they think it's justified, and so you sleepwalk into these policy accidents, and I think that's where the ECB will be very conscientious of today.
Well, if you're talking about sleepwalking into a policy accident, then what does it mean in terms of, let's scenario plan for a minute here. Should they hike again? What does that mean in terms of the read-through to the economy and tightening financial conditions?
Because with every additional hike, you put more downward pressure on demand at this point. If the ECB stop now or go one further, to Danny's point, I don't think that is a serious policy mistake. We may find that we fall into a technical recession over the course of winter. What makes me a little bit nervous heading into the second part of the year, with core inflation still too high relative to targets almost everywhere, is if the oil price starts to creep higher, if it gets to a big number, if we get a bit of a spike on gas, and then CPI data start to come in stronger than expected. We already had a bit of that in the US. Then central banks and markets might think, ouch, we need to go a little bit further. And so you can see a pathway into a policy accident. I don't think a hike today would be that policy accident, let's be clear.
So speaking of oil, I'm glad you brought us there, because how much of the shock in oil prices, how much does that pose a threat to what the ECB is trying to accomplish longer term?
So if I were a policymaker at the ECB, I would try to say to markets, monetary policy today is restrictive. And as a result, any supply-related surge in the oil price would be something that we should be able to look through. Because the problem that we had last year was we focused too much on the fact that CPI was close to target when the gas price went up, but didn't recognize that monetary policy was too accommodative. Now, of course, that would implicitly mean that the central banks would have to admit that they're partly responsible for the inflation surge, which they are. But that, for me, would be the way to go about it. Remember what happened with the Bank of England, though, in spring, when the market started to see a couple of CPI prints that were too high, money markets go up, and Bank of England says, ouch, we have a credibility issue here, we better follow the market. So the setup here is fairly dangerous for central banks. They have to be very, very clear about where they think monetary policy will be, how they might react in terms of these surprises, and what that might mean for inflation next year.
Could we get a hawkish QT surprise from the ECB? Is that out of the question?
I think that's unlikely.
Okay.
I think the bond market is skittish, it's tired, it's been a long year. The market already knows that central banks are not afraid to cause recessions if they need to. Roughly speaking, inflation expectations, interest rates are well anchored. So surprising with the QT announcement, it's probably a little bit too early. It's probably different for the Bank of England at the next meeting because they've already forewarned markets. And remember, the thing with QT is it's all about not surprising. They want this to happen in the background, not as a policy tightening. And I've been saying for a while now, we should be calling this quantitative reversal, not quantitative tightening, because there's no intended tightening here. There's no surprise, and it's small scale.
The problem is QR is taken by a QR code, so we can't use that one, Callum. Otherwise, it's perfect.
There we go. Barcode monetary policy.
Yeah, I mean, sure, why not? Look, to kind of zoom things out and look at the globe, and perhaps even the U.S. a little bit, this whole idea of, the last leg of the mile from getting from, 3 to 2%, that being the most difficult part. I was really taken by comments from the Walmart CEO yesterday, who said that there's been a bit of rebalancing as it relates to higher wages in the country, and that inflation and higher prices are kind of with us. Do you think that narrative is going to take more of a hold, that narrative is the right one, rather, that maybe we shouldn't be talking about going down to 2%? I know that this has been started to debate more, but if you have the Walmart CEO now starting to incorporate that into his language, is that threat more real?
I think that's a realistic scenario. I think we've gone from a world where after the global financial crisis, central banks targeted 2%, but were happy with anything above 1%. Now we're in a world where we target 2% and we're happy with anything below 3%. And I think the danger here is if you decide we just need to get to 2% and you cause needless recessions, you put the economy back to sleep, you get back into that sluggish funk of low interest rates, low inflation. I think that's the last thing that the US and the Western world needs, and I think policymakers actually know this. And so I think we'll stop, we'll see where we get to next year, and then we can adjust. If we're at 3% inflation with no recession, that's a good outcome from where we've been.
Berenberg's Callum Pickering, thank you very much for your time. Now stay with Bloomberg for full coverage of the ECB decision due at 8:15 a.m. Eastern Time. And up next, we're tracking ARM ahead of its NASDAQ trading debut later today. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
If you do care about fundamentals and you've got a fiduciary duty to manage risk, this stock's just really too expensive. So is NVIDIA, so is Tesla. Does that mean it won't stop going up? Maybe not. Are we closer to the end of this sort of hype bull cycle than we are to the beginning? I would expect so. Can I tell you exactly when the music's going to stop? No. But I do think it's helpful to let investors understand the level of fundamental risk they are taking in buying an IPO at this price.
That was David Traynor of New Constructs. And based on his own discounted cash flows, he believes that even if ARM increased its profit by 10 times, it would still be too expensive at the price it's being given by public market investors. But here's the thing. There have only been a handful of IPOs this year, and companies with ties to the booming industry of artificial intelligence, they're getting higher multiples. ARM prices its IPO at the high end of its targeted range and starts trading today. Joining us now is Matt Bloxham of Bloomberg Intelligence and Bloomberg Television's Tom McKenzie. Matt, it's interesting, when the bankers were trying to price this, Masayoshi Son of SoftBank had said that he wanted to do $51 a share instead of the potential $52 a share to ensure a smooth debut today. But how much of this is a matter of valuation, Matt?
Well, I mean, clearly valuation is incredibly important to people, you know, and really ARM does have to grow into that valuation. You know, they've set out a kind of very clear story that's kind of, you know, essentially ARM is the foundation of everything to do with technology. You know, it's at the core of pretty much every kind of processor out there, and they have this huge addressable market. You know, I think it's roughly about 100 times earnings if you look at the historical reported numbers, so they need to grow sales and profits quite substantially to kind of bring that multiple down. That's clearly what investors are believing that they can do.
Tom, does this tell us anything, how this IPO goes today, about appetite in general about chips, or is this just an IPO story? What does this tell us about the broader environment?
It certainly will tell us something about the appetite around artificial intelligence and whether or not, and there's some big ifs, and Matt has all the details on this, but in terms of if they can actually transition away from their dependence on smartphones, and we know that that is a sector that remains soft. It's going to be interesting to see how much uptake there is for the iPhone 15. But if they can actually transition away from smartphones towards the data centers that René Haas, the CEO of ARM, keeps talking about, and of course those AI chips. But we know, we've talked about the fact that they're central to their business right now are CPUs, not the GPUs, the chips that NVIDIA is so important in, and whether they can play some catch up there. So yes, it will give us a sense in terms of the appetite of artificial intelligence, but clearly and crucially, whether or not investors are really betting that ARM can make that shift, and in what kind of time frame.
Matt, how likely does it seem that they could make a shift like that?
Well, I mean, I think when you look at the business and certainly what they're doing, and you know, the kind of the rhetoric, like, you know, NVIDIA wanted to buy this company. NVIDIA's at the center of the kind of whole AI transition. So I guess clearly NVIDIA sees ARM core to its future. So I think that's an encouraging sign. But yeah, it is a double if. You know, can ARM make that transition away from smartphones? Can the AI momentum that we're seeing today continue beyond the short term? Two big ifs. But I guess, you know, investors like a kind of fairly clear story that they can understand. Even if there are question marks around it, it's a very clear story, and that's what they're buying into.
How much are the risks, Tom, tied to China relevant to the story here? When you look at the macro picture, the thing that underwriters can't control is what happens after today. But really what happens after today is the whole story.
So, I mean, to Matt's point and the broader part of this discussion, look, there's no question that this is a significant and impressive business, but it's all, as you said in the lead up to this, around the valuation. And the China component is really important. They do have this China unit, and what came out in the prospectus within multiple pages and paragraph after paragraph talking about the potential China risk and the fact that they have far less control over that China unit than many had expected. And of course, many of their designs in terms of the software and the architecture is used in terms of the design of chips that goes into chips, whether it's in the auto sector or into the smartphones that are used in China. There are the sanctions in place, of course, that really consequential move towards the end of last year by the White House to really restrict the use of chips and US technology. So they're vulnerable on that front as well. And China is going to be key in terms of gauging the risks for ARM longer term.
Now, the reality of the situation is SoftBank is only floating a part here of the ARM existing stock. Matt, if you think about SoftBank's ownership and governance, on one hand, their control over the company can be seen as both a positive and a negative. How do you see it?
Yeah, I think it's certainly a question mark. I guess, you know, the general expectation would be that SoftBank's going to sell down more shares over time, looking to kind of, I guess, ideally monetize a higher value for the business. You know, I think SoftBank, the good thing about SoftBank for investors is they're a very well-known entity. It's obviously been a bit of an up and down time for them in recent years, and perhaps, you know, the kind of vision fund hasn't played out the way they would have liked to. But I think historically, Masayoshi has a very good track record with investors. He's kind of well understood, and the business is well understood. And I think that's important. So, you know, people will kind of feel they've got a good idea of what they think SoftBank is and how they'll behave as an owner of ARM.
Well, this is the fact I got that I pulled from the Bloomberg story. It's selling about 10% of shares, and on average, companies IPOing in the U.S. float 29%. I mean, it is a really tiny float, to go back to Shanali's point. Tom, I mean, isn't this all just going to be passive money or money following passive indices, just having to buy ARM and chasing just really small shares?
So that may be a part of it, and we'll see whether it ends up in the S&P 500. But it does give, obviously, Masayoshi Son the optionality to come back and put more shares out on the market, doesn't it? But you're right, 10% is relatively small. There's a really intriguing component around the banks that are partner, of course. They've got a huge number of banks involved in this deal. And the loans that are tied up, the margin loans, that are tied up to Masayoshi Son and SoftBank and that relationship. So that's an intriguing component as well. So yes, we'll see to what extent that causes any concern at all. That relationship and those relationships are really important. And also just worth flagging, like, let's remember as well, more broadly for this IPO, you do have the backing now, the buy-in from Intel, TSMC, NVIDIA. That is going to give some confidence to investors as well.
Big day for ARM, big day for SoftBank, big day for Mizuho, Goldman, and all those underwriters. Our thanks to Matt Watson and me, absolutely, but it's an easier day for me, I would say. Coming up next, we're going to talk about the deadline for the United Auto Workers strike against GM, Ford, and Stellantis. It's set for tonight, and we'll have the latest on that standoff next. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with the plan.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shanali Basak in New York. All right, a quick look at what's ahead today. You know it. We've talked about it. The ECB rate decision, that will be at 8:15 a.m. Eastern time. Then President Lagarde's remarks hit at 8:45. Then U.S. PPI, retail sales, and jobless claims. All of those will come at 8:30 a.m. And then, of course, SoftBank's ARM will begin trading on the NASDAQ when the market opens. Shonali.
We're also keeping an eye on auto union talks as the strike deadline looms. UAW president says the union and major Detroit automakers are still far apart on a new labor contract. The Mercedes head of North America discussed the industry-wide implications.
We're not directly affected from a potential strike, which we wish it does not take place, as our two factories are not under UAW. But obviously, any disruption and any issue will have will give some shocking waves out to the whole industry.
Joining us now is Bloomberg's Craig Trudell, who has been following this story very closely. Craig, what are the tensions that are appearing so close to this deadline?
Yeah, it's kind of take your pick, right? Where I think we have a situation where these companies are in very strong position. Let's start with the good news that all three of these companies are in a pretty healthy spot in terms of making money and actually paying out pretty substantial profit sharing to employees. I think on the part of employees, I think there are a lot of concerns about whether pay has kept up with the amount of increase in earnings that we've seen from these companies the last few years. Concerns about the transition to EVs and batteries and whether or not union members are going to be brought along in that transition, and all manner of issues in terms of inflation. Whether or not battery workers will be represented by unions. So, there's a host of issues here that are, that go beyond just the auto industry that are really, significant to, the broader U.S. economy.
Another EV story we've been tracking. Yesterday, the European Commission President Ursula von der Leyen announced a probe into Chinese EVs and potentially non-competitive practices there. We heard from Chinese officials today. I mean, unsurprisingly, they're unhappy with it. But what exactly were they saying in I guess, response to this? Yeah, I think they're pushing back against the idea that China is doing anything, special here or different from what the rest of the world is doing. And they, of course, have a point in that respect that, the whole world is trying to kind of help, usher in this new era of electric vehicles. And to do so, you need to support the car companies. You need to support a battery supply chain being started. I do think that when we sort of, think back to what's happened and how China has sort of gotten to the position it has, for decades, it was requiring international companies to come in and set up joint ventures. We haven't seen, the rest of the world take that approach. It did sort of give preferential treatment to its, battery suppliers that helped, make CATL the dominant force that it is today. So are there specific things to China's industry that sort of, have helped them, become so dominant? Absolutely. But they do have some grounds here to play, this game of whataboutism.
Right. Our thanks to Bloomberg's Craig Trudell. Now, a look at some of the stocks we're watching in pre-market trading in the United States. The automakers are trading very mixed today. UAW prepares that strike, and deal talks are dragging on those stocks sometimes. Ford says it's continuing to put 100% into reaching an agreement with UAW. You are watching Stellantis down about 0.2%. Ford up slightly on the day, and General Motors up 0.4%. We're also taking a look at the airline stocks because American and Delta shares are finally up. They had slumped quite significantly, the most in 2 months, after American cut its third quarter forecast in part because of a jump in jet fuel prices. A lot on the transportation front there, Danny, a lot on the infrastructure, a lot tied to oil, and a lot tied to labor. So these cross currents of the economy certainly shaking up.
And look, the airline story I like because, again, it goes to this argument that I mentioned from Cudmore that higher oil prices, higher fuel prices in general don't necessarily mean higher inflation. If companies, airlines don't have pricing power anymore, as they reported, fuel actually translated into lower growth and lower revenue for them.
It's not even winter yet. Let's see how long this all drags on for. That does it for Early Edition. Surveillance is up next. Stay with us for full coverage of the ECB decision due very soon. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The consumer is stretched here, right? We have to pay attention to that.
Whichever way you look at it, inflation is too high. The Fed has to rethink.
Rates can still move higher, and I think that's a really important thing for us to remember.
The market is not fully bought into this disinflationary trend idea.
I think we're actually going to go into a mild short recession going into next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Big day coming right up, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P slightly positive. Big data points a little bit later this morning. U.S. retail sales. Before we get there, an ECB rate decision, and later on today, a deadline, TK, for a big union taking on the Detroit 3.
Huge day. I didn't even know where to begin with all that. I'll start with a count-up clock from inflation yesterday. The follow-on of people digging into inflation, John, clearly shows many see disinflation, and that's what Lagarde is to confront today. Is Europe going to see what the U.S. sees right now? If they raise rates today, are they doing it at exactly the wrong time?
Do we get a hike? We're split right down the middle. Just go into the economist estimates. There's some big banks out there calling for a hike from the ECB a little bit later this morning, Bramo. Citi, Bank of America, HSBC, Goldman, BNP Paribas. Take your pick. There's a long line of them, a long list, and I think that list is growing after what we've heard in the last couple of days.
I have to say, Kit Jukes put it the best, where he basically said the market has been pricing since the mid-year that the ECB is going to raise rates from the current 3.75% to 4%. The question is just, how are they going to do it? Are they going to do it today and then hold and indicate a hold, or are they going to hold and then indicate they're going to raise rates further? The biggest surprise is any variation from that particular iteration of decisions.
You know, I think like the airlines yesterday, American Airlines, and what we're seeing there, I think Helene Becker joins us today, which is wonderful, an informed voice. But there is disinflation in the air, and yet in Europe we're talking about inflation. And I just think this Thursday is a huge pivot point and a real point of tension.
Does this smell like disinflation to you? UAW, big union, taking on the Detroit Big Three with like 36% pay raises. This is what's on the table, according to the president of that union.
Even if you get the 20% you mentioned yesterday?
Ford has proposed 20% over 4 years. GM has offered 18%. Stellantis has offered 17.5%. And based on reports, TK, there's still a big gap between the two.
Huge gap.
And we might not close it by midnight.
Let's get the day calendar here. Amy told me 10 p.m. tonight is maybe where they get out front of this and pick a union. You know, there may be an announcement before midnight tonight. Cinderella's going to come out with a pumpkin, and before that, we're going to find out maybe
the strategy, by the way, is quite interesting. Yeah. They won't name a location. It could be in several locations. It could be a limited strike initially. They won't tell you, Bramo, because they don't want to allow the manufacturers, the auto companies, to plan for the potential strike that could happen starting at midnight.
They want it to be maximally disruptive without the maximum economic hit. This is what I see. And so that's the reason why at 10 p.m., as Tom mentioned, you're going to hear from Sean Fain as he comes out and tries to detail where they might try to start the strike.
With the news flow today, and I think for all of us on radio and television, it's like there's no countdown clock today. It's just never ending. It's going to go through the entire day.
I think we've got an ECB one, TK, to use.
Yeah, but then you listen to, I mean, I said to somebody yesterday, I said, this is maybe the most important press conference Lagarde's ever held.
Certainly the most uncertain
everything.
One. Yeah, an indecisive ECB. They've got to make a decision a little bit later today.
Somebody's going to go, well, you know, is Germany driving the bus or is Portugal driving the bus? And our answer will be interesting.
Well, if Germany was driving a bus, I'm not sure what they'd ask for, given where growth is right now in Germany.
Yeah.
Traditionally, they'd be saying hike, given where inflation is, but they've got a tough economy.
This is a fascinating day. I'm going to also point out on the data, John, as you started, the VIX 13.30. These are terrible markets.
Well, let's get to it. Equity futures, given all the drama we just talked about, they are positive on the S&P 500 by 0.3%. Yields are a little bit higher by a single basis point, 425.85, and a Euro TK going absolutely nowhere, 107.29.
Again, Swissy gives back here. It's not giving me a lot of angst and fear this morning. The major issue I have is, do you think the white titanium iPhone says me?
Oh, you're thinking about it?
Should I go?
This might happen.
They have like these subtle green, brown, darker titanium. Or should I really do a color reach and go for the white?
Are you doing a family plan?
I'm doing.
Is everyone else
when you got vet and kennel fee, everybody else is on too.
Have you managed to construct this in a way that you're hardly paying any money?
I am. I think I have. And I did it off the Apple website, and they go right into the carriers. Dan Ives nailed this. Nailed it. AT&T clearly is the most desperate, and the other two are sort of kind of like following on.
Are we going to find some space to talk about this later? Maybe.
Yeah, I just,
perhaps.
I don't,
okay.
I mean...
I have a feeling this is what you really want to talk about, not the ECB, not unions, not the data that's coming out a little bit later.
I just figure I can find a white iPhone in a bar faster than a black one.
You know? Ramos, save us.
All right, well, we're going to talk about maybe the time frame for some of the other decisions where Christine Lagarde is going to come out and talk about her iPhone purchases. No, she will not. 8:15 a.m. we get the ECB rate decision, followed by an 8:45 a.m. press conference. Christine Lagarde has a very difficult needle to thread. She is looking at inflation of about 5.3% in the Euro region, still way too high. The expectation that they're only going to downgrade it to 3% next year. Stuck between a rock and a hard place. You got to imagine she might say the S word, stagflation, the nightmare of central banks. 8:30 a.m. we get U.S. PPI and retail sales. I am actually more interested in retail sales and the potential for a negative headline print, even with what we're seeing from gas prices that have been climbing. Auto prices and auto sales volume has been coming down. Again, can consumers keep absorbing the price increases that companies need to charge to break even, at least with the same types of margins? And at 11:59 is that deadline for UAW negotiations. I am watching the 10 p.m. Press conference of Sean Fain. I think that will be really interesting to understand their strategy, John, as you were talking about, of how they plan to wage a war against the auto manufacturers without losing enough clout in terms of wreaking economic havoc at a time of a pretty sensitive moment.
Got something like 14 hours to close that gap. Let's see if we can. Joining us now is Ben Gutteridge, the investment director over at Invesco. Ben, wonderful to start the program with you this morning. Let's start here. What is there to like about the US equity market currently?
Well, I think quite a bit, actually. You know, I think the backdrop is of resilient growth and a policy cohort that will probably decide to go on hold from here. That type of mix, resilient growth, more accommodative or less hawkish policy could fuel yet more gains in the US equity market. Of course, with all the other long-standing tailwinds for the US equity market, including sort of innovation and a place where shareholders can enjoy the spoils of that innovation as well.
Ben Gutteridge, you were at Loughborough. Is that how you pronounce it, John? Loughborough, did you okay? Loughborough.
Nice.
Yeah, thank you.
That's right. Yeah.
One of my heroes was there. Eric Pentecost is a giant in my mind in economics. Is the systems within the Eric Pentecost textbook, are they still in play? Like at Invesco every day, are you literally making up the theories as you go? Or is this actually finance and economics from our models of the past that we can use now?
Well, a fascinating reference. Doesn't come up much, but look, I mean, we're not making it up as we go along at Invesco. I can assure you of that. But my job isn't so much making economic forecasts as investment forecasts. And if our view is that rather than pinpoint economic forecasts, if the economy can be relatively resilient, coupled with policy that's as I say, it would take a hike, take a pause on hiking, and so is relatively more accommodative. That's like a nice tailwind. I mean, recessionary risks do linger as we move into next year. They're quite material, but for the time being, end of cycle stuff isn't such a bad period to be an equity.
Within your wheelhouse, and given what you just said about a resilient economy, does 60-40 work?
Well, I certainly think the 60 works. The 40 should do a bit better. I mean, clearly it's been a dreadful part of the portfolio for some 18 months. So that the maths of the bond component looks a bit more asymmetric. Looks like there should be a little less downside relative to the past. But also, if we have this sort of disinflationary narrative, and that the CPI report yesterday sort of supports the idea that it still is that the trends are still disinflationary ex-shelter, but that should sort of come through. Leading indicators on rent suggest that the shelter component can come down. Then a disinflationary backdrop would be okay for the 40 as well. It would always encourage a little bit more diversification and alternatives and real assets and a bit of cash, but not too troubled by a 60-40 portfolio.
Ben, it feels like trading the end of a cycle is like dancing on the head of a pin, trying to figure out when you can capitalize on the very tail end of the momentum, the increasing disinflation, the policy hold before recession sets in. How do you know when it's over, when the end of cycle season has just reached the end?
Well, I mean, that's sort of the point, is it's very difficult to know. So sort of swinging too defensively there are some risks in that, and I think end of cycle behaviour does lend itself to investors moving towards areas where there's more perceived areas of secure growth, and that would be like loosely defined technology, certainly US equities. But if you're of the view that the recession, all recessions are obviously awful, but that this recession, end of cycle event, might be relatively mild versus those more recent recessions, then that encourages you to be a little bit more overweight equities. Yes, we've got to brace ourselves for volatility, but perhaps it might not be so punishing as in past end of cycle events. And that, as I said, encourages the modest overweight to equities.
The areas of growth that you mentioned are focused in the U.S., and you are overweight more in the U.S. than elsewhere. In Europe, where does that come from at a time where the ECB is facing stagflation, where the banks are passing along these higher rates without the prospect of more loans? You're facing a lot of headwinds, so how do you get enthusiastic about European equities?
Well, it's quite hard as you've laid out. Yeah, I mean the valuation is a starting point. But there isn't too much thereafter. Clearly, the economic headwinds are a bit challenging. Policy, it's on a knife edge, isn't it? But certainly, you would think, based on how they behaved during that sort of financial crisis wobble at the start of the year, I think they want to show their inflation-fighting credentials. So policy not yet getting favourable, and clearly China. The impact that China has on the European economy also a challenge. So I would look to the ECB to get more accommodative and for Chinese policy to get firmly more stimulative before moving more assertively towards European equities. Maybe not too far away, but not at the moment.
Ben, just quickly, hike or no hike later this morning in 2 hours?
I would say hike.
Hike? Okay. Ben, thank you. Ben Gutteridge there of Invesco. Joining the team, a long list of people looking for a hike a little bit later. The median outlook in our survey suggests no hike, but it's so split right now for the ECB. And a lot of people started to rethink about what we might get from the European Central Bank, because we get a set of forecasts a little bit later this morning. And we had a report from Reuters a couple of days ago suggesting that maybe in the 2024 forecast for inflation, that's revised higher to above 3%. TK, I've got some good news for a certain Manus Cranny, our friend from Dubai moving to New York. Do you want the good news?
Please.
Manhattan rents topping. Right on cue. So Manus, Cranny is basically calling the top of the rental market in New York City.
He is. He's locked in for a 5-year, I don't know. He's got a view of the East River, and, he's got the whole thing.
All good stuff.
All good stuff. He's large. But thrilled to have Manus come here and bring, what the problem, folks, that you have with Manus Cranny is if you're at breakfast with John Farrow and Manus Cranny together, you only understand about one every 4 words,
You kept up yesterday.
Between the British accent and the Irish accent.
It's only slightly rude to the whole of the United Kingdom, Tom, and Ireland as well.
I'm offended, and I'm not even there.
Do you want the bad news, Bramo? It's still 4,400.
That's exactly what I was going to say.
Median rent for new leases signed last month, 4,400, unchanged from the record set in July, according to the appraiser Miller Samuel and brokerage Douglas Elliman. I guess another spot of good news, Lisa. You would expect August to be really hot, and based on leases signed that I can see in this data, it wasn't that hot at all.
So the good news, as you said, that prices are topping out. The bad news is they're still up 35% from where they were in August 2021. So it still is really expensive, and they don't necessarily expect price declines. And this is something we heard from Jonathan Miller.
As I said yesterday, I think it was with Paul Sweeney in the 9 o'clock hour, and I said, when you're analyzing inflation, you got to wait a couple hours. You can't do it two minutes in.
To get the full breakdown.
You gotta break it down like a David Rosenberg would do. And the answer is yes, services popped a little bit, core services, but the rest of it's going the other way, 3-month annualized. And if you take a present rent calculation, it's very 3-ish.
Very 3-ish. Is that what we're calling it?
3-ish.
Okay.
3-ish.
Lisa mentioned 35% higher from August 21.
That's a level up.
Up 7.3% from a year ago. So,
yay!
I'm not going to pretend it's any good.
Rate right now, maybe
Manhattan rent. Terry Haynes of Pangaea joining us next on the looming UAW strike from New York City. Good morning.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Will the ECB hike or pause this week?
There's a lot in flux at the moment.
ECB, they're stepping harder and harder on the brakes.
You have to be cautious.
It's much too early to think about a pause.
Inflation expectations remain anchored at 2%.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Is there a real danger of over-tightening at this point?
Stopping too early is a bigger problem.
Coverage begins today on Bloomberg. Context changes everything.
We're making progress at each of the 3 negotiating tables, but as you just heard, we're still very far apart on our key priorities. To win, we're likely going to have to take action. We are preparing to strike these companies in a way they've never seen before.
The deadline is midnight tonight. That was UAW President Sean Fain outlining the organization's plans to strike against the big three automakers as the negotiation deadline nears. On the table, an offer from UAW of a 36% pay raise coming back at them, according to President Fain. Ford proposed 20% raises over 4 years. GM offering 18%. Stellantis offering 17.5%. There's still a wide spread there, TK. Can we close it through the rest of today?
How Teamsters was that? I mean, I think the Teamsters thing a couple weeks ago changed the debate, the tone, the body language of these people. This guy knows he's got his union behind him.
Has he got the president behind him too?
Don't know.
Emboldened by the White House as well.
That tone of voice, I didn't hear 2 or 3 years ago.
You know, have they really been emboldened by the White House? This is a damned if he does, damned if he doesn't kind of moment. And there hasn't been that much, based on the number of reports, there hasn't been that much involvement by the White House. They get involved and they fail to stave off some sort of strike. They're bad. Yeah. If they get involved and there is some sort of strike or they get to some resolution that hurts anyone, then they're bad. Like, either way, they're not going to be looked at well if they get involved.
There's a bit of lose-lose to this, TK, going into this one later.
Yeah. You talking ECB or you talking Joe? Or
no, I was talking about the strike that would potentially happen later on this evening, TK.
Yeah.
UAW. I didn't switch to the ECB.
I'm fascinated.
I can talk about the ECB if you want.
Who the company will be. Oh, that's lose-lose too.
What does she think about it?
But I'm fascinated who they pick is a strike company.
Maybe they go through all
there's
three
always a message
in different locations. The TK. I think they're being very cagey about the strategy because they don't want the automakers to plan for it.
Okay, we'll see. Terry Haynes will be up then. He'll be.
Let's see what Terry's call is: strike or no strike.
Right now, we've got a 2-hour conversation with Terry Haynes, a news flow out of Washington extraordinary. He's with Pangea Policy. I'm going to digress here because he's the only one that'll remember this, and then Lisa and John have some serious questions, including UAW. There we were, Terry, on the couch in 1968, and LBJ in Vietnam said, "I give up." David Ignatius dropped a bombshell 2 days ago. Amory Horton and I went back and forth on it right away. When is Biden going to do an LBJ?
Right now, I think never. They've put a situation in place here where he's the only alternative in the party. That there really isn't another alternative, and everybody else is staying on the bench. And, you've got the Washington chattering classes going on about the need for change, but there's no alternative. Folks are not thrilled about the prospect of Biden standing aside and having a free-for-all that potentially.
But that's the Democratic Party. Come on, back to Grover Cleveland Alexander, the 2-term president in the 19th century. That's the way the Democrats do it. When have the Democrats ever been a smooth operation out of a campaign? They're supposed to have, a complete mess to get to the convention, right? In the smoke-filled rooms.
Well, historically, there are two things I could say about Democrats are, the first, insert the Will Rogers comment about belonging to no organized political party. The second, though, I will say that when it's time to whack somebody, as they say in New York, Democrats are much better at that than Republicans are. That said, I don't see the situation changing with President Biden anytime soon.
So, Terry, do you expect a strike or no strike? And how is this White House going to deal with it?
My instinct is, Lisa, and it is instinct, is no strike. And I will tell you why. Simply that they're not negotiating in public. That's always a good sign, whether you're talking about politics or union negotiations. And the union was very clear about kind of what they wanted, which was kind of get back in front of the wage train and protect their workers in an EV transition. By implication, they're also being clear about what sort of overreach there is. Number one. Number two, the automakers are motivated to have some sort of a resolution. And thirdly, as you all pointed out in the intro, lurking in the background is the White House, which very much wants a resolution, and I think we'll try to apply some pressure to get one.
Well, it seems like there hasn't been that much involvement from the White House. There were a number of reports talking about specific individuals involved, which haven't been at the very top. It's been the acting labor secretary, Julie Su. Again, they haven't really named a full labor secretary at this point, certainly not someone who's been out in front. Gene Sperling, a White House advisor, also has been a liaison to this. Other than that, there really hasn't been that much involvement. Do you think that that was a political mistake?
I think having Sperling and Sue involved is an indication of serious engagement by the White House. Gene's a very serious guy. The labor secretary you would expect to be involved, and she probably pushed to be involved. So those seem to me like the right people. The question to me is what both rhetorically and in a bully pulpit sense Biden is willing to do. This is somebody who claims that he's the most pro-union president ever. So Franklin Roosevelt is spitting in his grave, among others. But that UAW created the American middle class and deserves an appropriate contract, and Biden sees the negotiation as essential to pushing the EV transition forward. For all those reasons, the White House is going to have to stay involved. I think you accurately pointed out the two bad choices, but and the downside is potentially worse than the upside. But they've got to get involved for the upside.
What is the ideal outcome for this White House?
No, the ideal is a contract that is accepted by all sides, that shows real movement forward, that the president can push to say this pushes my ideals about union ownership, union membership, union participation, and frankly, he gets the endorsement of the UAW, which has been hanging out there.
Right. Terry, I went back 2 years to Politico looking at union discussions between Trump and Biden. Do you have any knowledge or perspective if UAW line workers are supporting the former president or the present president?
I don't have anything granular on that. I will say that there is has been for some time a major disconnect between what union leadership wants their rank and file to vote, or how they want them to vote, and how those rank and file actually vote. I mean, they're the same hotbeds in Detroit, in Pittsburgh, and the like are all places that were heavily for Trump and made the elections much closer than they did otherwise. I wouldn't expect that to change much, frankly.
Terry, got to go. Got a bit of breaking news, sir. Thanks for being with us. Terry Haynes there of Pangaea Policy on the latest with the strikes, potential strikes, a little bit later on today. Here's the breaking news for you. The reserve requirement ratio over at China gets a cut, a trim of 0.25 percentage points. The cut will be effective from September 15th. So a slight bit of easing, Tom, on the supply of credit, not necessarily the price of it, but ultimately easing the reserve requirement ratio for Chinese banks over in China.
Just in the last 24 hours against this, I mean, there's the whole financial thing, the property thing and that, and deflation, disinflation, all blah, blah, blah. You know what? A lot of the zeitgeist is the economy's still doing okay. We got to remind ourselves, is this a 3% China GDP, 5%? Dare I say, could it be more, even with all this financial upset?
4 is the number you hear a lot of, Tom. Yeah. A lot of revisions away from 5 towards 4. And Lisa put that on the long list of action we've seen from Chinese officials over the last couple of weeks, the last month.
Which is the reason why the moves have been, what is it, easing talk, easing light, not necessarily that aggressive, which raises a question how far they're going to go.
I think we need a surveillance road trip to Shanghai.
I'm sure you do.
Of us on the deck there.
That doesn't shock me, Tom.
I can just see it, looking down the Bund.
Yeah.
Bramo on the Bund. I like that.
An easing posture over in China. Sarah Hewen of Standard Chartered on the ECB next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The PBOC out moments ago with a reserve requirement ratio cut, just a small one, 0.25 percentage points, but that on top of everything else we've seen from that nation over the last month, an easing posture out of China. Your equity market on the S&P 500 positive by 1/3%, lots to look forward to. US retail sales, a straight deadline for Detroit's Big Three, and an ECB rate decision just around the corner. Equity futures higher on the Nasdaq, up by 0.4%. Into the bond market, the 2-year closed above 5% on Tuesday, broke back below it yesterday, still below it right now, up by a single basis point to 4.9776. The 10-year 4.2565. Tom, into retail sales a little bit later this morning.
Yeah, we got a do we have a countdown clock for retail sales? Come on, we're slipping, Amy, in the control room. We need a countdown clock on retail sales, and we need a count up clock from when the ECB announces to get to Lagarde's president.
You want to count up from it?
I want to count up. Lisa,
okay.
you were gone
Lisa,
yesterday.
it doesn't have to make sense.
You were at a meeting yesterday.
You were saying this yesterday.
You were at a meeting yesterday with your people, and Lisa and I were like advocating for a count up clock off of inflation.
You want to count up afterwards,
Yeah, afterwards.
so you can say like 21 minutes since.
So McKee can give us further data.
Sure. All right.
You know,
we'll
it
work
works
that out,
out.
Tom. We'll figure that out.
Peter Cheer, with a really smart Zero Hedge, published it out of Academy of Securities, a really smart note
What did he
last
say?
night on real rates. He said real rates matter, and the key thing, Bram will comment on this. I usually look at the 10-year because I'm a lazy equity guy. He said the 5-year is more important. The 5-year real rate, inflation-adjusted rate, is what the pro over at Academy Securities looks at.
Everyone's been saying they want the belly of the curve, right? Isn't that the sort of consensus call right now? And so that perhaps is what Peter Scheer is talking about. No, Tom, he's not talking about you. He's talking about just in general. And this is something we keep seeing, John, as people try to capitalize on bonds that might not be trash, although Ray Dalio might think they're trash.
Everything's about you, Tom. Everything's about you. Don't worry about it. You'll upset him.
Dalio was what, at Milken?
Yeah.
I think so, yeah.
They interviewed him, and to get this right, he doesn't like bonds priced down yield.
Cash is no longer trash because
Cash is no
has
longer
a yield.
trash.
And, yeah, basically.
I mean, look, Joe and Tracy interviewed Bill Gross, and it's like a legit deal. They're qualified. Bill Gross is running $1 gajillion.
You're suggesting that Ray Dalio is not qualified?
No, I just think Ray's, come on. Wait a minute. The last time we heard from Ray, cash was trash, right?
Something like that. It was a few years ago.
Okay,
It was a few years ago when rates
He
were at
moved
zero.
Okay.
Basically, there's a spare seat around the table, and Ray is welcome anytime. Is that the message you'd like to send?
Yeah, I think
Good.
Ray can come in and we
Good.
can clarify,
Okay.
Clarify cash.
I'm pleased we've cleared that up. In foreign exchange, the euro has not had a close above 108 for about 2 weeks. We're at 107, 107.31.
What do you think
Totally
today?
unchanged. 8 weeks of dollar strength is what I think, TK.
Yeah.
And if you want a toxic brew, Lisa Abrowitz, then you've got one. You do not want a weaker euro and a higher crude price in Europe. That stuff is brutal. And that's where the ECB is right now.
If Christine Lagarde does not take a somewhat dire tone today, I think she'll be tone deaf. That's what I'm thinking, that she has to signal how difficult their decision is at a time where they want to support the euro, and they have to hike rates one more time in order to support the euro. But they also are dealing with a very difficult economic picture, downgrading growth with a German recession.
I totally agree with what you're saying in terms of oil. She's going to take a different tact for one reason only: oil.
Tough spot,
yeah.
The energy story. Under surveillance this morning, the United Auto Workers and the big three automakers remaining far apart in talks on a new labour contract as the midnight deadline approaches. UAW President Sean Fain saying at a Facebook Live, "We are prepared to strike these companies in a way they've never seen before." The Ford CEO, Jim Farley, said the union hasn't made a, quote, serious counteroffer to any of Ford's proposals, adding, "We're here, we're ready to negotiate, but it's sure hard to negotiate a contract, Tom, when there's no one to negotiate with."
Yeah, well, it's there, and it's Ford, and I don't know what they're going to do. Why do you go after the one company that didn't go bankrupt? Politically, to go after Ford, to me, would be odd, given the government challenges of the other
You think
two.
they pick one somewhere else?
The tradition is they pick one so they can strike longer. They can the fund that they have will last longer. You know, this goes back 100 years.
If you wanted to maintain public support for what you were doing, pick the one which no one's ever heard of, Stellantis.
I don't disagree with that. No, John,
if you strike
I think you're onto
Stellantis
something.
and you're sort of somewhere, I don't know, pick a state wherever, and you've never heard of Stellantis,
Totally.
what does that even mean?
Which is the reason why, and I hate to read too much into a small price move, Stellantis shares are down pre-market.
I'd be beating
Ford
up on... No,
and
I'm
GM.
not-
Yeah. What are you going to beat up on? Like, go ahead, keep going.
I'm giving them my strategy for union negotiations. I'm probably not best placed to do that.
I think you're perfect.
Just a call on the ECB rate decision 2 hours away, with markets split on whether President Lagarde will pause or deliver a 10th straight rate hike. Jeff Yu, BNY Mellon, one of our friends on this program, weighing in, saying, quote, "We have to acknowledge the hawkish shift in expectations over the last 2 weeks. The risk-reward heading into the decision is not good for the euro. The euro is absolutely unchanged." And your third and final story, we're on IPO watch. SoftBank's ARM pricing its IPO at the top end of the range, selling shares for $51 when trading begins on the chip designer later on this morning. The IPO is the biggest of the year, with Bloomberg reporting it was oversubscribed, Lisa, more than 10 times.
Still, though, just to give you some perspective, valuing the company substantially below the $64 billion of just a couple years ago at $54.5 billion. So, yes, substantially higher, but it's a small portion. And, Tom, honestly, you were right to point out this is basically a marketing shtick to try to get as many people into the market as possible.
Again. For those of you on radio, you're not missing it. Lisa's killing this. Bring it up again if you would, Amy. I don't know if it's not in the trash bin yet. Down at the bottom, there's all the numbers, the math, and all this. And John got merch when he went to the road show. Great. SoftBank maintains 90% stake. I still don't get this modern IPO stuff. What in God's name are they doing other than to cash out a bunch of bakers? Mizuho had a good day. Dominic Constantine's probably buying breakfast.
Oh, Mizuho is making money on this, right?
Rashudo and Constant are buying breakfast.
Do you think you can learn anything from this IPO anyway, given the nature of the company that's being listed?
I'm not qualified to answer that. I defer to Anurag Rana.
Okay.
You know, he was the one that would do it. Let's jump into it. We go to Europe, and I want John to lead this conversation because the first time I saw John Farrell was on the lawn of the Otmar Issing ECB building long ago and far away. Sarah Hewen qualified to talk about this
You know what I love about your story
meeting.
of meeting me? He forgets when we actually first met.
You got that right.
Years before that. Sarah Hewen, head of Europe and America's research
Street,
at
some bar down in Alley.
That's closer to the truth. Sarah, welcome to the program. Hike or no hike from the CCB in a few hours' time?
It's on a knife edge, isn't it? I mean, we think no hike. If you look at the data, the economy is close to stalling, if not already turning down. There's a very weak outlook for the for growth. Inflation, sure, it's still higher than it needs to be, but core inflation has come down, and we think that this sort of growth outlook will bring inflation pressures down further. The issue, of course, is the small nudge up that we've seen in inflation expectations, and importantly, the fact that the inflation forecasts for this time around are going to have to be revised quite substantially. It's quite tough. We recognise it's quite tough for Lagarde to say we're on hold, but by the way, we expect inflation to be higher this year and next year. So very much a knife edge.
Sarah, if Germany and a German recession can't bring down inflation, what will?
We'll get there in the end. I mean, recession ultimately will damage the labour market. It will dampen wage growth. It will restrict businesses' ability to pass on price increases, which has been a big part of the inflation story, don't forget. And you get to your 2% inflation target. I think what we're questioning is how far are they going to be focusing on their forecasts for next year's inflation, how far on the medium term, 2025. The forecasting horizon has always been 2 years. Where are we going to be in 2 years' time? If they up their forecasts for 2025 inflation, then that shows that they just don't believe they're not going to be able to meet the target as under the current policy stance.
Sarah, you're expert on this, and of course Standard Chartered has a wonderful European and particularly Eastern European look. How homogenous is the ECB today? Americans will go Germany, Portugal, or maybe we'll look at core and we'll say something about Italy or Greece. We're uninformed. Is it cohesive in a meeting today, or is it cats and dogs arguing that Lagarde never talks about?
I'm sure there are very robust discussions, put it that way. And I'm not sure that it necessarily relates to the domestic economies as well. There are really across the board weakness in the euro area to a lesser or greater extent. And the hawks on the ECB Council are not necessarily those that are in economies that are doing well. But there is a sort of big split. You can see very clearly that some policymakers are very concerned about the growth picture and feel very strongly that that is going to be bringing inflation down. They're really concerned that another rate hike will tip the economy into a deeper than necessary recession. Others just feel that you cannot stop while you have headline inflation and core inflation at 5.3%, sort of 2-3 times the target.
Right now, we're talking about how Christine Lagarde, the ECB president, is between a rock and a hard place. So, too, is the euro. And there's this real question of how much the ECB is watching the euro and hoping it stays at this level. What is the level at which the ECB starts to sweat about imported inflation at exactly the worst time?
I think that we're still some way from that. We've always seen in the past when the euro gets to parity that is the point at which we get verbal intervention. There are so many bigger problems, I would say, for the economy at the moment than the value of the euro. The euro is obviously helping the region's exporters. Imported inflation anyway is not what the policymakers are concerned about at the moment. They're concerned about domestically driven inflation. So even though we are seeing higher energy costs, and that is a worry, I think the concern over higher energy is equally balanced between the impact on inflation expectations, which will drive them higher, but also the drag on growth, the headwind to growth that in an environment which is already pretty much recessionary.
Do you expect Christine Lagarde to talk a lot about the long and variable lags that maybe are coming to the fore more quickly in Europe? Can you speak to how much they're going to speak about a hold being restrictive increasingly as time goes on?
I think that that's a very good point to make. As inflation comes down, if rates are staying unchanged, we can already see the impact on financing conditions, on credit availability, on the growth in the money supply, which has slowed very dramatically. So I think that they will emphasize the point that policy is restrictive and will stay restrictive for a long time. The mantra may well be that rate cuts are not on the horizon. They will want to send the message that of higher for longer, rather than give any impression. Certainly, they won't give any impression today that they are done, and they will want to send the message that policy is set to stay restrictive until they are confident that the inflation target is within reach.
That decision about 90 minutes away. Sarah, thank you. Sarah Hewen there of Standard Chartered. About 30 minutes after that, you'll hear from President Lagarde in the ECB news conference, and somewhere in between, you're going to get some forecasts from this European Central Bank, which could show inflation next year forecasted to be above 3%, which is why there are many economists out there predicting we get a rate hike from the ECB. Sarah Hewen is not one of them. Up next on this program, Helene Becker of TD Cowen on the airlines. We've got to talk about the downgrades to the outlook that we've seen from Spirit, from American Airlines. The airlines this month on the S&P 500 down more than 8%. From the July highs, we're down more than 22%. Higher labour costs, Tom, higher fuel costs, and maybe even softer demand and lower ticket prices that they have to confront through the rest of this year.
And the partition of economy to business is just extraordinary how that's maintained. I look at one flight overnight, and the ratio of business fares to economy was 5 to 1. How do you run an airline with a 5 to 1 ratio between the cost of the fancy people up front and everybody else in back?
What's your go-to? Still New York to Paris?
No, I'm looking New York to Paris as a base fee. Everybody wants to go. Then also EWR
it's
to
not like
JFK.
a busy travel corridor in America. It's like
to LAX as well. New York
okay,
to LAX as well. It's gone down. It's way down.
Like the glamour routes.
Way down. The kids are traveling like they're going to dinner in LA. They come back in the midnight.
Helene Becker of TD Cowen on the airlines coming up next from New York City this morning. Good morning to you all. US retail sales and ECB rate decision and a strike deadline later on for Detroit's Big Three. All of that is coming up.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
We've already seen a lot more struggles with the pricing going forward as people are starting to pull back on their travel. So I think that is a big issue and why we think we're going to go to a recession. Higher energy prices is going to continue to cool spending by the consumer. As we approach $4 a gallon, I think that's going to conserve people's what they have to spend, and that's going to further lead to some weakness by consumer spending into the year end.
Earlier this summer, it felt so good to be an airline. Not to be a passenger on those airlines, to be an airline. That story has changed and changed quickly. We start September. On the month, we're down by more than 8% for the airlines on the S&P 500. That was Larry Adam there, the Chief Investment Officer over at Raymond James. TK, yesterday it was Spirit, it was American Airlines. It makes you wonder this morning, who's next?
Yeah, and the zeitgeist stuff, it's got to be United, Delta, maybe Alaska steps in that. John, I looked at the return of the S&P index. Thanks for your help on that. Where pre-pandemic, they're like negative 13%. At the bottom of the pandemic, when they got $1 gajillion worth of government support, they've made like 8% per year. In the last 10 years, this index is up 4.4% per year. Is that any way to run a business?
The chart of it's amazing. If you look at the run-up through the summer, oh, look, everyone's going to Greece. They're going to Italy. I'll pay anything. Please fly me there. And then all of a sudden...
And we did.
Fuel prices higher, Lisa. Labour unions want a slice of it. And now we're talking about softer demand and lower ticket prices too.
Where do they cut costs? This is my question, because they're still hiring people and having to offer up big to get people in the door to even keep the thing fully staffed. They've already cut your peanuts. They've already cut your the size of your seat. They've already cut your overhead compartment. They've already cut your line order. So at what point do they have the room to even begin to shrink expenses in a way that doesn't materially impact demand?
I love it when TK gets personal. The seats are ridiculous.
I was
flying business class. Just picture this. TK flying business class and there is still no space. I've got photos of it.
Yeah,
there is still no space.
I believe it.
I mean, I get on and the pilots look back through the door and laugh at me. But I'm on the flight. We're going to keep the airline name out of this because I don't want Helene Becker in trouble. And the food was so bad. I said to them, why don't you just serve Swanson TV dinners? Just give us our youth.
But you pre-order. I pre-order with American.
Oh, do you?
I always pre-order with American, yeah.
You like to pre-order? I got an email.
I like to pre-order, yeah. Just get ahead of it. Get the meal that you want.
Okay, so, we blew up yesterday with American Airlines. Who knows today? Joining us now with experience, she has seen this before, with TD Cowen, Helene Becker. Helene, thank you so much for taking time out. I just want to go to the shot here, out 12 months, out 36 months. What's your single best buy of these beleaguered airlines at this moment?
Yeah, so we like Copa. It's a mid-cap airline company, Copa Airlines, based in Panama. They've got a 4% dividend yield, and their commitment is to raise the dividend, or to pay out 50% of adjusted net income. So every March, they'll look at this year's net income and then adjust the dividend. We've moved away from the domestic U.S. airlines. As you know, last time, Tom, I was here, it was United was our best idea. And we've kind of moved away because of the things you three have been talking about all morning. The idea that people aren't traveling as much, the hybrid work environment is coming to a bit of an end. You can't keep taking your kids out of school to go traveling every weekend.
Keep it up, Helene. Mrs. Keen's watching at home. Keep it going. Come on.
And so what winds up happening is demand goes down, and that's what the airlines are saying. We had our conference in Boston last Wednesday, and we had Alaskan, United, Sun Country, and Allegiant update. And then yesterday at another conference, we had American Spirit and Frontier.
Elaine, so you're in your conference. It's all friends, and I know that, and there's nobody watching, so we can talk frankly here. American comes out with a bombshell yesterday. What are Bastian and Kirby going to do? They got to go and did they say, we're going to take the third flight from LA to Reno? It's gone? I mean, what is the to-do right now for these people after what they went through with the pandemic?
Yeah, it's really awful. I was in Washington earlier this week at a conference, and the message from the industry to government is you need to fix air traffic control, first and foremost. We're short 3,000 air traffic controllers in this country. We train a net about 500 or 600, which is a 5 to 6 year backlog. And that's just to keep things flat. We're down so much relative to where we should be, and it impacts the entire network because it causes airlines to burn extra fuel. They don't manage their they can't manage their day-to-day operations well. And from what can the airlines do? Well, they're not getting productivity improvements with these expensive contracts that they're giving. So the only thing they can do is keep raising prices, but that destroys demand. And the focus, I think, will be on more seats per departure, but they have all the wrong aircraft for that. So that means more CapEx at a higher interest rate. So the industry is getting its margins squeezed. There's not a lot they can do from an productivity perspective because they're doing less flying with more people. You've got fuel costs going up. Brent's over $90 a barrel right now, and that's not changing in the short term from what I've heard from our energy analysts. And so the outlook is really getting very concerning for these airlines because we're expecting 2024 to see flat to down earnings versus flat to up earnings.
Given some of the difficulties that you've just mentioned, Helene, do you believe the pandemic is a convenient scapegoat or the reason for some of those problems?
So I think I think they're using it as a scapegoat, but frankly, I think these problems existed before. You know, you guys who know, I've been talking about the looming pilot shortage for 10 years now, since December of 2013. And so when you think about that, we've been talking about the air traffic control shortage for 5 years. So nobody's paid attention, and now they're saying, oh, it's because of the pandemic. No, it's not. These problems were going to exist. The pandemic just intensified it and made it worse than it otherwise would have been by encouraging many people to retire 1 to 3 years ahead of time.
Helene, how much are airlines going to become credit card companies? And that's basically where they're going right now. Everyone has to get an American Express labeled with their corporate logo, and then they get all sorts of perks, and everybody who actually flies, forget about it.
Yeah, so that's a whole nother thing, because isn't Congress going through this this process right now where they want to change the whole way loyalty programs work and take away a lot of those benefits that airlines receive? But yes, that's the place where airlines make money, right? They can get remuneration from the credit card companies. They have the ancillary fees, because once you have the airline ticket, they charge you for bags, they charge you for seat assignments, some airlines charge you for water, and so on. And so that's where the revenue benefits are going to come in, because those are high margin sectors of the revenue pie. But as far as ticket prices go, that's really what they have to do. They have to raise ticket prices to cover higher costs. And
yeah, but they're not. Come on, Helene, they're not raising prices. I mean, prices are coming down,
right? Yeah. Prices are coming down, so margins are getting squeezed, and that doesn't bode well for stock prices.
Is this a business? It's a crazy business.
Helene, do you want to answer that one? Is it?
Well, I've been doing it a long time, as you know, and I've seen this movie before, Jonathan, as you observed, and it doesn't end well.
Helene Becker, when you say it doesn't end well, are you saying we're going to lose some airlines here?
I think at some point in the second half of the decade, the answer is yes. Not everybody's going to survive this looming downturn. Deja vu all over again.
Do you think we need mergers and acquisitions to avoid that?
Yes, absolutely. We need fewer, having fewer airlines hasn't helped either, right? Because everybody complains about the service, and I complain too. I pre-ordered my meal on a flight home Friday night, and she gave it away. She gave it to another passenger who might have had more status on my flight than I did. But
did you kick up a fuss, Helene? I just want to understand how you responded to that. What did you say?
I said, you gave away my meal. What were you thinking?
Is she the one? Is she? If you're LAX to New York and they're landing in Kansas City, is it Helene Becker?
It's a thin line.
They didn't load my meal coming back from Jackson, going through Dallas.
Yeah, they didn't load mine either.
I was very relaxed about it. It's okay. It's really not their fault.
I'm getting more like they're so beleaguered. Every seat's taken.
Were you more relaxed about it so that they didn't land the plane in Kansas?
I was very relaxed about it because it was a few hours away. And I was going to eat at Dallas. The selection of food at the airport there is fantastic.
Now, I mean, Helene's was the high ground on this, but what I find on every flight, there's always one idiot. And the
Tell us more. Who is that idiot?
Only
one. Are you talking about passengers or staff here?
But there's just always, they're focused on one idiot who's like, they got to take care of him.
Kicking up a fuss.
Yeah.
Yeah. Different cabins, TK. Helene Becker there of TD Cowen. That's usually in first.
Copa, Panama.
Yeah. Latin American Airlines are where it's at.
You go to Buenos Aires, which is a long ways away. We could do the show from Buenos Aires.
Straight down for
summer in Buenos Aires.
Make that happen, TK.
Yeah, we could do that.
Great exchange rate for you. Michael Showler, Market Field.
Unclear what it is.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today,
I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
The consumer is stretched here, right? We have to pay attention to that.
Whichever way you look at it, inflation is too high. The Fed has to rethink.
Rates can still move higher, and I think that's a really important thing for us to remember.
The market is not fully bought into this disinflationary trend idea.
I think we're actually going to go into a mild short recession going into next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive. Near session highs up by 0.4%. Later on this morning, U.S. retail sales and jobless claims. Before we get there, an ECB rate decision. Later on tonight, Tom, we're expecting a news conference from UAW, the big union taking on Detroit's Big Three, because 2 hours after that, 10 p.m., that news conference potentially, Tom.
Yeah.
Midnight is that deadline to strike a deal with Detroit's Big Three.
I just went to our engineers in our control room, the team that we've got with their interns, and, they use Chat GTP, GPT, and all that AI stuff.
How's that working out?
I want 3 countdown clocks today. We need 3
What are your 3 events?
8:30,
Data, the
10
ECB.
p.m. No, 8:30, like ECB economics.
Okay, we're counting up.
10 p.m., like Lisa says, she's staying up for 10 p.m. when the union speaks, and then 12 midnight, we'll see if the Cinderella comes out and gives us a strike.
Pick a story. Data, ECB, strikes.
It's a tough call. It's a really good question because I think retail sales become more important because of inflation yesterday. But I got to go with ECB. I think from an historical standpoint, it's not, folks, for those of you in America, this isn't the Fed. It's going to be different.
So much harder for President Lagarde today. So, Lisa, let's go through what this ECB is stuck between. Inflation forecast for next year, which might be above 3% based on recent reporting. A growth outlook that may have to be downgraded based on what's going to happen with Germany, potentially in contraction for all of this year. Then you've got this rally in crude, this weakness in the euro, put it all together. Doesn't sound great, does it?
It's the nightmare for central banks, which is stagflation. It is the worst recipe that any central bank has to deal with, which raises the question, especially if the market is expecting the ECB to eventually, before the end of this year, get to 4% and then hold. Why not just raise to 4% and then say, we're done? You know, this is going to be something that will become increasingly restrictive over time. And we understand that inflation is a major problem. We also understand that we've got weakening growth. This is where we're going to sit and see what happens.
That's the ECB. Let's talk about negotiations here stateside between the big three and UAW. This is what's on the table at the moment. UAW started at 40% for a pay raise, came down to 36%. This is the offer so far, according to the union. Ford has proposed 20% raises over 4 years. GM has offered 18%, Stellantis has offered 17.5%. And Tom, there's a real feeling that we can't close the gap between now and tonight.
Based on the Bloomberg discussion yesterday, I'd say we can't close the gap. And to me, it's like the Teamsters. I said in the last hour, this is, well, if you're the head of the union, how do you not behave like the Teamsters and just say, this is the way it's going to be, we're going on strike?
Why wouldn't you?
What are the consequences if they go on strike? They don't build cars. I get it. What happens on the inventory lots? I have not seen enough work about to the three automakers who gets hurt the hardest and how soon they get hurt.
From what we've heard about EV inventories, Lisa, maybe it wouldn't be a bad thing at some of these places.
Exactly. That actually they've got pretty hefty inventories, so they might be able to clear them out if the workers stop manufacturing. What's at risk for them to do this, Tom, is a good question, but there are some real things at risk, including moving factories out of union-friendly states, which we've already seen, to the south, possibly not necessarily getting the support of the White House if they're really pushed against the wall, if it creates too much economic damage. They could push too hard, and I think that is in the balance, and that seems to be evident.
Isn't Elon Musk and Tesla just sitting there rubbing their hands together, loving every second of this?
I imagine so.